gives yield or return, cash inflows, right? So that will be the revenue for the future prospects of your business, right? So and then moreover, time period of the assets will be very longer. Its benefits derived from the assets will be very longer, more than 12 months. That is, it may be 5 years or 10 years. So the fund which is generated, profit is generated through these assets, right? That is why the capital budgeting is very, very important aspect. So capital budgeting decision, it is a yield or return over a period of time, right? It involves current outlay or series of outlays of cash resources in return for anticipated flow of future benefits. So what is the cash flows? Will benefits derived from that assets in future. So that you have to take it into your consideration. So capital budgeting is employed to evaluate expenditure decision which involve current outlays but are likely to produce benefits over a period of time longer than 1 year, right? So what are all the features of capital budgeting? So what are all the features? Main thing is potentially large anticipated benefits, that is cash inflows. Relatively high degree of risk. Yes, risk is more risk because of the revenue generated through these assets. A relatively long time period between the initial outlay and the anticipated returns. Yes, if you are investing now, it will take time to generate the income for longer period. So there is a long period between the investment amount and when it will take time to get back your money from that assets. So these are all the basic features. What are all the needs and the importance of capital budgeting? That is, I already explained you, that is high investments. Investment value of the money will be high, right? So say for an example, it may be in lakhs or it may be in crores, depends upon the nature of the business and size of the company. It varies, right? So the amount of which is invested in the assets and liabilities or assets, plant and machinery or land and building, it is a huge investment of fund. Then it is a long term nature of asset, that is a risk, high financial risk is involved for investment decision making. So we need to be very careful for planning the capital budgeting. Then irreversible. Once you have taken decision making for investing such kind of assets, you cannot revert back. You cannot cancel it. Once you have installed, you have to face the risk, right? So that is why it is irreversible. It is very important while taking decision making. Then long term effect, the effect of purchase of assets that not only reduces the cost but also increases the revenue of long term period. It brings significant changes over a period of time and investment. It may be sometimes it may be a over investment or under investment. So you should be very carefully to utilize optimum utilization of these assets that generates future revenues. So these are all the very important needs and importance of capital budgeting decision making. Next, let us see capital budgeting decision making. There are various processes are there. So what are all the processes which are involved while taking decision making? So let us see what are the steps. First, you are planning to buy, say for an example, as a layman, you are planning to buy a refrigerator or TV to your home. So what are the process which you involve? Just like that, go and buy the TV or refrigerator. What are all the things you will choose? How will you choose? How will you take decision making of which kind of brand you are going to buy? What is the amount of investment you have? What are the process which involve for buying a TV? Can you say anybody else? Yes.
Gathering information of different products.
First thing, you have to consider what kind of product you want, isn't it? So what you are going to buy, refrigerator or TV, which is essential for your home. Your home, you may have plenty of demands or plenty of needs. So which needs give priority to buy right now? So right now, first you have to identify which product you are required, right? Then next, what you will decide? What will you decide?
What are the available products?
Fund. How much fund is available to buy that
Select
product?
all the
If you have, if you want to buy refrigerator or television, you need at least minimum 20,000, 30,000, isn't it? So what is the budget? Cost of the budget you have, that you have to determine how much money you are fund you can allocate for that. Then next, what will you think?
Options available in the market.
What is its how much that is you have to identify various alternative sources of assets, right? So if you want to buy TV, there are lot of plenty of brands are available, isn't it? So which brand you want to buy? So which brand comes to your budget, right? So what is its plus minus, merits and demerits? So what is the maintenance cost? What is the its lifetime? So these are all the things you have to decide. Then after that, you go for a showroom, and then you will order, and then you have to buy. This is as a layman, small thing. When you are purchasing, you have to undergo all these process. In case of company, you have to take one more process. You have to find out how much, you have to assess what is the cash flows generated from that asset. So cash flows means what if you are buying plant and machinery, how much production you can generate, how many units you can produce from that plant and machinery, what is its income from that. So these are the things you have to involve, you have to decide, you have to find out or identify, determine all these things. You have to all these process which are involving to take decision making. See here, what are the steps or in capital budgeting process. First one, to identify the new products and services to be considered. You have to identify which one you are going to buy, what is required for your business. Determine the cost of the project. Cost, what is the budget? That is 2 lakhs or 5 lakhs or 10 lakhs, 2 crores. Same machinery you can buy 2 lakhs or you can buy 20 lakhs. Depends upon the brand. Not only brand, depends upon the productivity, right? Then assess the future cash flows, and then salvage of the asset. Salvage means what? What is salvage value? At the end of the life of the asset, if you are replacing to another machinery, so you have to sell it out in the market, so you will get some residual value, that is called salvage value, right? So you have to assess what is the future cash flows of the asset, and what is the residual value of the asset. And then you have to assess the riskiness of the project. So riskiness, whether when you are after installing that, so whether that machinery will produce what according to your expectation. Say for an example, if you are going for buying second hand machinery, so second hand machinery, it is very risky. Whether it will generate, whether it will properly come for operation, we do not know. So you have to be very careful about the riskiness of the asset. And then you have to find out, you have to estimate the future cash flows in the present value. What is present value? Present value factor you have to apply on the future cash inflows. What is the present value? Today 1 rupee value, after 1 year its value will be reduced. Year after year, value of the money will be reduced, right? 1 rupee value, next year it will be a 90 paise, then second year it might be a 80 paise, like that, right? So that is the present value of future cash flows. You have to estimate the present value of future cash flows. Then next you have to find out what is the required rate of return. What is required rate of return means what? That is called internal rate of return. Required rate of return or minimum rate of return. That means, yeah, once what you are investing in your asset, instead of investing, if you are investing somewhere else, say for an example, you are, instead of buying plant and machinery, if you are depositing in the bank, minimum you are earning 5% or 6% interest, right? So that is called minimum rate of return. So that minimum rate of return or cutoff rate, here we are calculating, it is called internal rate of return. So you have to calculate what is the internal rate of return of that future cash inflows, right? Then next one, you have to find out what is the acceptable net present value. Then you have to select various alternatives. You have to find out which alternative, which machinery gives you the best result, best endeavor. So you have to choose that one. So these are all the process which are involved in taking decision making of capital budgeting. Next, you have to see what are all the methods to evaluate the your project. So, how to evaluate the purchase of while purchasing the plant and machinery or your investment. These are all the methods which we can use it for evaluating. That is payback period method, accounting or average rate of return method, then net present value method, then profitability index method, internal rate of return method. So these are all the methods for evaluating the your cash proceeds of your future cash proceeds from your plant and machinery. So out of this, payback period method and average or accounting rate of return method, these two methods are traditional methods. Traditional methods, no need to calculate the present value factor. You have to take only how much you are investing, within how many years you will get back your money. That is called payback method. Average or accounting rate of return method, which proposal will gives you higher rate of return. So in this case, while taking decision making, there are various ways are there. What are the various ways? Whether rationing, capital rationing decision, or mutually exclusive decision making, or you have to choose which one gives you the higher return, like that, right? So out of this net present value method, profitability index method, and internal rate of return method, these three methods which involves the discount factor or present value factor, which involves for finding the that we can say as a time value of money. Time value of money, which involves under these three methods for calculating your cash proceeds, cash inflows values of your plant and machinery. Let us see one by one. First one, payback method. Payback period method. Payback period method means what? The period which is required to recover to initial investment of your project. Say for an example, you are investing 10,000 rupees, sorry, 1 lakh rupees. Every year your cash inflows you are getting from that asset is 20,000. So how many years are required to take back your investment? How many years required? 1 lakh is the initial investment. Every year your cash inflows are 20,000. How many years are required to take back your investment?
5 years.
5 years. Very good. This is called payback period method. So what is the time required to get back, recover your initial investment? That method is called payback period method. Under this method, what are the merits and demerits? Let us see here. It is very simple method, simple calculation. The formula is initial investment divided by annual cash inflows. That is initial investment 1 lakh, annual cash inflows, that is 20,000. So 5 years. The payback period is 5 years. So this method provides only for what is the amount of return you are receiving from that period, and then it gives you only the possibility of what is the cash inflows. The obsolescence of the asset is ignored in this. What is the demerits? Time, it ignores the time value of money. Time value of the money means the cash flows will not be discounted rate, right? Then it ignores all cash flows after the payback period. Cash inflows, that is, say for an example, project A gives you cash inflows for only 6 years, 20,000 each, only 6 years. That is 1 lakh means 1,20,000 your returns. Machinery B, every year it gives 10,000, but its lifetime is 20 years. So how much is your returns? 2 lakhs. 20 years, 1 lakh per year, 10,000. That means its inflows is totally 2 lakhs. But machinery A gives you only 1,20,000. But as per the method of payback period method, which one will you choose? Which machinery will you choose? Machinery A. Machinery A gives you returns within 5 years. You can get back your initial investment within 5 years. But in case of machinery B, it will take 10 years. But with this method, it ignores the rest of the inflows of the period, isn't it? So this is the demerits of the this method, right? Then accept or reject criteria. So how will you accept or reject under this method? So you have to give the preference only for predetermined period of your payback. That is, which machinery gives you lesser period, that you are going to take decision making. So the future cash flows, it is ignored. This is the accept or rejecting criteria. See this problem, example I have given here. Project A investment cost is 30,000, cash inflows 10,000. The life of the project is 5 years. Project B investment cost is 40,000 and the cash inflows 10,000. The life of the period project is 5 years. So what is the payback period for project A? 30,000 is the initial investment divided by 10,000 each year. So how many years payback period?
3 years.
3 years. For project B, 40,000 divided by 10,000, 4 years. So which machinery will you choose?
Project
Project
A.
B.
Project A. So project A will gives you the minimum period to recover your initial investment, right? So in this case, cash inflows are even. Every year it is 10,000. Suppose if it is uneven cash inflows, how to calculate payback period? See here, uneven cash flows for first year 5,000, second year 8,000, third year 10,000, like that. So you have to calculate payback period for uneven cash inflows. So what is the initial investment of your business? This project 25,000. So your cash inflows are uneven for 6 years, 5,000, 8,000, 10,000, like that. So now you calculate cumulative cash inflows. First year 5,000, second year 8,000. So totally 13,000 at the end of the second year. At the end of the third year, 23,000. What is your investment? 25,000. So within 3 years, 23,000 you are receiving. So 23,000 means 3 years plus how much is required for that? Only 2,000. So next year, 2,000 divided by 12,000 you are earning in the fourth year. 12,000 for whole 12 months you are earning. So 2 months is required. Sorry, 2,000 is required. How long it will take? 2 months. So 3 years plus 2,000 divided by 12,000. Remaining amount, how much is required? 2,000 divided by 12,000. That is into 12 months. How many period is required to get back your money? 3 years plus 2 months. Do you understand? When your cash inflows are uneven, you have to calculate the payback period like this, right? Can we go for next method? Next method is accounting rate of return or average rate of return method or return on investment. We can say it is a return on investment method. So under this method, the average profit we have to take into account. So what is the average profit that you have to consider after depreciation and taxation profit you have to take? So cash inflows every year you are receiving 5 years or 10 years, whatever it is, you have to take it average. Per year, first year 10,000, second year 20,000, third year 15,000, like that. You have to add it and divide by number of years. That profit you have to take, you have to keep it in your mind. Under accounting rate or average rate of return, you have to take after taxation and depreciation. Okay. So what is the formula for average rate of return method? Average annual profits after taxation and depreciation divided by average investment or initial investment. There are two methods are there. Either we can take initial investment or average investment. Average investment is nothing but, say for an example, if you are investing 1 lakh, 1 lakh divided by 2, that is average investment. Initial investment or original investment means 1 lakh. You have to take divided by take original investment. These both the formulas can be used. Different authors using different formulas. So you can use anything, no problem. So what are all the merits and demerits under this method? This method is very simple to calculate this average rate of return. What is the percentage of profit earned on the asset? It is a very basic accounting information of cash flows, right? Basic accounting information, how much profit you will earn. That is the thing you are going to find out. What is the this method? We are not considering time value of money. Time value of money you are not considering for the cash proceeds. That is demerit, as well as it is no need to calculate the present value factor. It considers the total benefits associated with the project. Payback method, we are considering only the time period. Under accounting rate of return method, we are considering total benefits of the project. So what is the percentage of profit derived from that asset, right? These are the merits and demerits. What is the acceptance or rejecting criteria? Which project gives you more percentage of profit? That project should be accepted. Higher rate of return, which gives higher rate of returns. See this problem. A company has two alternative proposal 1 and proposal 2, right? There are two methods, automatic machinery and then ordinary machinery. Cost of the machine investment is 2,20,000 for proposal 1, for proposal 2, 60,000. Estimated life of the period for proposal 1, 5.5 years. Proposal 2, 8 years. Estimated sales per annum, that is 1,50,000. Proposal 2, 1,50,000. Both the machineries gives you the estimated sales, same 1,50,000. Cost of the material, that is material, labor and variable overheads, totally 50,000. Here 50,000, labor here 12,000, here 60,000, variable overheads 24,000, 20,000. So calculate the profitability of the proposals under accounting rate of return method. Let us calculate. First one, cost of the machinery for automatic machine 2,20,000, ordinary machine 60,000. So what is the sales? Now we have to find out what is the profit under proposal 1, automatic machine, under ordinary machine. So what are the expenditures? Sales minus all the variable expenditure. Variable expenditure, that is material, labor and variable overheads, and also you have to deduct depreciation. I already told you, after depreciation and taxation we have to take the profit, right? So in this case, a percentage of taxation is not given. So let us deduct only depreciation. So material, labor, variable overheads are given in the problem. We have to take into consideration. And then depreciation you have to calculate. How to calculate depreciation? What is the cost of the machine? 2,20,000 divided by, let us take straight line method of depreciation. Straight line method, how will you calculate depreciation? Initial investment divided by estimated life of the machinery. So that is 2,20,000 divided by 5.5 years. So per year depreciation is 40,000 under automatic machinery. Under ordinary machinery, that is 60,000 divided by 8 years. So how much it is? Depreciation 7,500, right? So now you have to calculate what is the profit. 1,50,000 minus this total expenditure is 1,26,000. So 24,000 is the profit under automatic machinery. Under ordinary machinery, it is 1,50,000 minus 1,37,500. So profit is 12,500, right? So now we have to calculate ARR, accounting rate of return method. What is the formula? Average profit. This is 1 year profit. So no need to do average. So if suppose if it is this profits are given for 5 years or 10 years, we have to take divided by 5 year or 10 year. This is 1 year. 1 year profit is, that is average, 24,000. we can take initial investment or average investment. Initial here, if you apply the formula of average investment, that is 2,20,000 divided by 2. That is average investment into 100. So in case of automatic machinery, your accounting rate of return is 21.82%. Right? You calculate it. 24,000 divided by 1,10,000 into 100. What is your profit percentage? ARR percentage? 21.82%. So if you calculate for ordinary machinery, that is 12,500 divided by 60,000 divided by 2, average. So 30,000 into 100. So the profit ARR percentage is 41.7%. Right?
Excuse me, madam, why we are dividing by 2 for the initial investment?
Average.
By
We
2?
have applied the formula of average investment. If you are applying the formula of original investment, no need to divide by 2. 2,20,000 you can take. What depends upon, there are different authors are following different formula. Either you
Okay.
can go for original investment or you can go for average investment. No, nothing
Okay,
wrong
average
with it.
investment, I got it, but why we are dividing by 2?
Average
Is what
means
I'm.
2 divided by 2.
Average means
No, you
Okay.
should not take the estimated life of the period, right? You have to
Between 2. No, how this 2 is arrived still I was not able to
2.
understand why.
That
It's
is,
the
you are
standard for all
averaging
this.
at the initial period. The average investment value is 2,20,000, right? So if
Okay,
you are
okay,
taking average means divided by 2. Initial
okay,
opening investment value plus closing investment value divided by 2.
okay,
Opening
okay,
value is also 2,20,000. Closing value is also 2,20,000. Right? So that is why we
okay.
are taking averages divided by 2. Or it nothing wrong in that. If you are taking formula instead of average, you can take original investment. Original investment. So in that case, no need to go for divided by 2. This is also correct.
Okay, ma'am. Clear.
So now you calculate how much it comes. No, don't go this. It is up to you. How much comes now? 10.24,000 divided by 2,20,000 into
10.9, ma'am. 10.9.
10.9. That is also correct. 10.9%. In this case, 20.8. Correct?
Yes, ma'am. 20.8.
So you can
20.83, yes.
nothing wrong in that. So depends upon the formula. If you are taking original investment, the ARR rate is 10.9%, 10.8%. If you are taking a average investment means that is 20 point something, here 40 point something. So we have to take decision making criteria. So which machinery gives you more profitability? Will you choose ordinary machine or automatic machine?
Ordinary, since its percentage is more as per this
Ordinary
calculation.
machine profit percentage is more, that is 20.8%. We choose the ordinary machinery as the based on this accounting rate of return method. But this is a very disadvantageous. What I mean, your fixed expenditure, it is higher in case of automatic machinery, that is depreciation is greater than the ordinary machinery, right? So if you go for more productivity, that automatic machinery will gives you more productivity instead of 1,50,000, your sales gives you more production. You can choose automatic machinery because when your fixed expenditure is more or variable expenditure is lesser, when you are extending, increasing your productivity, you can profitability will be greater in case of automatic machine. So this is the disadvantage of accounting rate of return method, right? That you will study in leverage. Next one I will teach you leverage, how the automatic machinery will be the profitable one. So that when you understand, when I teach you the leverage method, so you will understand that. Okay. So under accounting rate of return method, we can choose ordinary machinery will be the profitable one, right? The next method is net present value method. What is net present value? Present value means what? What is present value? Present value means the time value of money. Time value of money means today 1 rupee value will be the lower the next year, isn't it? Do you agree or not? So 1 rupee value will be reduced to 90 paise. So that means what? Price of the product will be increased. The value of the money day by day it will be decreased. Today if you have 5 lakhs, after 5 years will be the same value for same 5 lakhs? No, you will not get it, isn't it? So that is the time value of money factor is considered, that is called present value factor. This present value factor, you have to take the annuity table, present value factor, that is discount factor in the future cash flows. So present value factor in the future cash flows, that is already I explained you, that is discount rate, minimum rate of return, that is cost, overall cost of capital we have calculated now, that is the minimum cost of rate we are taking here as a cut-off rate or discounted rate, that is 10% or 15%, whatever it is, that we are taking here as for finding the annuity value, right? So this is the net present, that is present value of cash inflows, the difference between the present value of cash inflows and present value of cash outflow. Outflow means investment value. That is called net present value. Net present value, which project gives you the higher positive present value, if you are getting that project you can accept. So in case of mutually exclusive decision making, which proposal gives you greater net present value, that you can choose, right? So what is the merits and demerits of under this method? Net present value method recognize the time value of money, and then it gives the total benefits arising out of the proposal, and then it is the best method for selection of mutually exclusive project, and which gives you to achieve the maximization of shareholders' wealth. What is the maximization of shareholders' wealth? The value of the company which gives you more, isn't it? Instead of getting profit maximization, the total value of the company should be greater. So what is the demerits? This method is a little bit difficult to calculate, the estimate the present value factor, and then it needs discount factor for calculation of present value, and it is not suitable for different projects. It is not suitable for all the projects, right? It is different. Let us see the problem. See this problem. From the following information, calculate net present value of two projects. That is, which project gives you the accepted discount rate. So the profits here, it is given before depreciation and after taxation. While calculating net present value, you should be very carefully keep it in your mind. The profit or cash flows, estimated cash flows from your investment should be after taxation but before depreciation. Depreciation you should be added with the cash inflows, right? But for after depreciation means what? Calculation of depreciation. Depreciation is an allowed expenditure, right? So after taxation, profit will be deducted the depreciation, but we need to calculate the profit before depreciation. That means you have to add back the depreciation into your cash flows. That I will explain you one more problem. Here simply let us take the profit which is given here. See here, project X, project Y, estimated life investment, initial investment 20,000, 30,000, estimated life 5 years, both are 5 years, scrap value 1,000, 2,000. cash inflows from project X and project Y are given. Here 10% is the discount rate is given. Present value factor, it is given this value. If you go for annuity table, present value table, for first year, this is the value 0.909, second year 0.826. This will be given in that table value, right? So how to calculate? Let us calculate here. Let us assume these cash flows are after taxation but before depreciation. Okay, it is given in the problem itself. The profits before depreciation and after taxation, right? So here project X, project Y, you have to take the 10% present value factor, multiply the cash flows into the discount factor. Project X value is calculated here, project Y value is calculated here. 5,000 into 0.909, that is 4,545. Likewise, you have to calculate 20,000 into 0.909, that is 18,180. So now you have to calculate total value of the cash flows, that is then scrap value. Scrap value means what? Residual value. Residual value, that is at the end you have to calculate end of the year. You have to deduct it from that value, right? So how much it is? Totally 24,227. This is 24,728. So what is your initial investment? 20,000, 30,000. So what is the NPV? Total cash proceeds 24,227. Your initial investment is 20,000. Project X is 4,000. NPV is 4,227. Project Y is 4,728. So in both the projects are acceptable because NPV are positive. When the NPV are positive, we can accept the project. So when your decision making criteria is mutually exclusive, so you have to decide whether project X or Y. So which project gives you greater positive NPV, you have to take. So which one
Project
will you
Y.
select? Project
Project Y.
Y. Project Y is positive, NPV is greater than project X. So we can select project Y. Do you understand this NPV, calculation of NPV? It is very, very important problem in your examination point of view. Case study. Case study, they may ask you to calculate NPV and IRR. Okay, so very
Ma'am, any formula is there for calculating this 4,545? How it can?
Hello?
Ma'am,
Speak
any
loudly,
formula
I
for this?
can't hear.
Any formula for this calculation project X and project Y? How we can calculate this?
Tell me.
4,545. How it will
Uh,
arrive?
uh, 4,540. Calculate 5,000 into 0.909.
Oh, okay, okay.
Multiply with the future cash flow is 5,000. You have to multiply with the discount factor. Discount
Okay, okay.
factor for is 9.909. 20,000 into 0.909 is 18,180.
Okay, madam. Okay, madam. Understood, ma'am. Thank you.
Okay.
Madam,
Yes.
the scrap value is taken after the estimated life, right? At the rate of
Scrap value at the end of the year, you will, if you want to replace it, when you are selling that asset, end of the 5th year, so that is why we are calculating that 5th year discount rate, discount factor.
Okay, madam. Okay.
Okay. Next, let us see internal rate of return method, that is IRR method. What is the internal rate of return? Internal rate of return, that means the rate at which equates the aggregate present value of your net cash inflow and then aggregate present value of net cash outflow, right? So this is the that means what? The NPV at the rate is equal to 0. One second. That means your project NPV, that is NPV, if you are calculating that present value of cash inflows are equal to your present value of your investment will be same. That means 0. That is called internal rate of return. Say for an example, here this method, your NPV instead of 4,227, if your cash present value is cash inflows, it comes to 20,000 at the 10% rate. So it is 0. So in that case, this 10% is the IRR, internal rate of return. Do you understand? The rate at which gives you the NPV is 0. That means what? The aggregate value of present value of your cash inflows are equal to your present value of your investment. That is equal. That rate called is a internal rate of return. That internal rate of return we can say as a minimum rate of return or cutoff rate. Right? The internal rate of return, it is a rate of return that earns the profit. What is the profit? Minimum rate of return. That rate which equates the aggregate present value of your net cash inflow with the aggregate present value of your cash outflow of the project. That means NPV is 0. You understand what is IRR? The rate at which the aggregate value of present value of your cash inflows are equal to your present value of your cash outflow becomes equal or 0. NPV is 0. That rate is called as internal rate of return or minimum rate of return or cutoff rate. Okay, that is called IRR. So what is the merits and demerits? That means what? This project, what is the minimum rate? How will you take the decision making? Say for an example, your overall cost of capital, if it is, you have to say for an example, 15%. Your internal rate of return of this project is 10%. So your shareholders expectation is 15%, but your projects gives you 10%. What is your decision making? What is your decision making regarding this? The expectation is high, but your minimum rate, cutoff rate gives you only 10%. So your wealth maximization we cannot get. Okay, so depends upon this. You have to take so many decision making. The decision making I will teach you later on. Now, let us see what is the merits and demerits of this internal rate of return method. It considers time value of money, that is a merit, and then it takes into account of total cash inflow and outflow. It does not use the concept of required rate of return. Required rate is not considering. It gives the what is the minimum rate of return. Minimum rate of return is different from required rate of return. Okay, it gives you the approximate or nearest rate of return. Exactly you cannot calculate, only approximated value you can find out. Demerits, what are all? It involves complicated calculations or a little bit complicated than the NPV, right? It produces multiple rates for taking decision making confusions, and it is assumed that intermediate cash flows invested in the internal rate of return. So what is the acceptance or rejecting criteria? So here, acceptance or rejecting criteria, when your IRR rate exceeds your required rate of return, that project can be acceptable. When the IRR is greater than your cost of equity or overall cost or required rate of return, when it is greater, you can accept that project. Suppose your IRR is lesser than your required rate, the overall cost of capital, so you have to reject that project. That is the decision making related to IRR. Let us see this problem. The formula for calculation of IRR. First, you have to calculate payback period. So for calculate while applying this formula, before that first step, you have to calculate PB means payback period. Payback period, you have to find out what is the value. From that, you have to locate the factor. Payback period, we can use it here for locating the factor. Percentage of discount rate where it is located, the cumulative annuity value. So how to calculate? I tell you, this is the formula. IRR is equal to R plus or minus. Plus or minus, why I have given here, if you are taking lesser interest discount rate, you have to take plus. If it is a higher interest rate, you have to take minus. That is why I have given plus or minus. Okay. PB means payback period you have to take. DF means discount factor for the interest rate which you are taking, and then divided by uh, discount factor for lower interest rate. Some echo is coming, I think.
Ma'am, this is Vanya. I'm asking, can you repeat that plus minus
That
part
while doing the
again with
problem,
the.
you can understand.
Okay, ma'am.
1 second, ma. 1 second. My voice is.
Hello, ma'am. You can continue. It is because of Vanya only that echo is coming. Ma'am, you are on mute.
Okay, I will continue. For you, no problem, no? Voice trouble?
No, no problem.
Okay. So this is the formula for payback period. DF means discount factor for the lower, that is interest rate. That is discount factor for lower interest rate, discount factor for higher interest rate, into difference in, that is a delta is called the difference of discount rate, higher interest rate, between higher interest rate and lower interest rate. You will let us see this problem, you will understand. A project cost 36,000 is expected to generate cash inflows of 11,200 annually for 5 years. Calculate IRR, right? So what is the first, we have to calculate payback period. What is the payback period? Initial investment 36,000 divided by what is the cash inflows annually, that is 11,200. So payback period is 3.214. Your factor payback period, we are taking it as a factor 3.214. Now we have to go for annuity table, that is cumulative annuity table, present value table. I show you the present value table. Can you see this? Once again. Now can you see this annuity table?
Yeah, yes, ma'am.
Little bit zoom.
See here, this is the present value
Please
table.
zoom, ma'am.
This is the present value table. Say for an example, 10 percentage we have seen, no? The 10 percentage first year 0.909. Somewhat clumsy. It's, why it is showing like this? One second, one second. One second. Can you see it clearly now? Can you see this now?
Yes, ma'am.
See
Can you-
here, this annuity table. This annuity table previously we have taken 10%. First year 0.909, second year 8.826, third year 7.51. This is the factor you have to calculate for NPV. That is 10% or 12%, 50%, whatever it is. According to this table, you have to take for calculation of present value. Okay. So see here, now we have to take this table. This is cumulative annuity table value for finding the IRR. So IRR, what is the payback factor we have calculated now? 3.214. Okay. 3.214, you have to see where is the nearest 5 years. You have to see 5 years, 3.214 where it comes. 5 years value 3.214. You see here, 3 point nearest is 16% under the 16% discount rate. The value 3.274. 17% under that value is 3.19. Right? So it is 3.214 is between 16% and 17%. Right? So let us take the discount factor for calculation of IRR, the 16% and 17%. 16% discount factor is 3.274, 17% 3.199. Okay, this one you just how to locate the factor. Let us see the problem. Wait. Okay, can you see it now? Can you see this now? Now, the payback period, what we have calculated, that is 3.14. Under cumulative, you have to locate that factor. It comes under between 16% discount rate and 17% discount rate. The present value discount factor under 16% is 3.214. Under 17% discount factor is 3.199. So, how to calculate the actual IRR? IRR is between 16% to 17%. Okay. So now if you apply this formula, if you take lower rate or interest rate, discount rate, that is 16%. If you are taking, you have to take plus. If you are taking 17%, higher discount rate, you have to take it as minus. Okay. So 16% if you are taking plus, here payback period value, that is factor is 3.214. Payback period value is 3.214. This discount factor for this 16% discount factor is 3.274. 16% discount factor is 3.274. Payback period is 3.214 divided by discount factor for lower interest rate That is, lower rate of interest is 16%, discount factor is 3.274 minus discount factor for higher rate of interest. This higher rate of interest is 17%, discount factor is 3.199. Okay. Into what is the difference between these two rates, 16 and 17, is 1 percentage. This is the difference. Okay. So now if you calculate, you will get 16.8%. This is the IRR. Or alternatively, you can take 17% discount rate. You have to take minus payback period value is 3.214 minus the discount factor for this rate. 17% discount factor is 3.199. Okay, 3.199 divided by the discount factor of lower interest rate and higher interest rate. Lower interest rate discount factor is 3.274 minus higher interest rate is 3.199 into the difference between these two rate is 1%. You pay, put it here 16%, here 1%, 1%. Okay. So if you calculate all these things, you will get same percentage. This is the IRR, calculation of IRR, internal rate of return is 16.8%. This is the simple calculation. Or you can do another method, trial and error basis. Trial and error basis, simply you can take a 10% discount factor. You have to multiply and calculate what is the total. 15% discount factor. Each year you have to calculate and find out what is this value. After that, you have to find out. It is difficult to calculate, very cumbersome process. Instead of, it is a very simple method to calculate, locate the IRR. It is a approximated value. We cannot find out exactly. So approximately the internal rate of return for this project is 16.8%. Do you understand this IRR? Do you have any doubt?
Yes, madam.
Madam, please repeat one more time.
One more time. Okay. So this is the formula for calculation of IRR. First, you have to find out payback period for locating the factor. Locating the factor, that is what is the estimation initial investment divided by annual cash inflow, that is payback period. Payback period under this problem is 3.214. Okay. So now we have to see the table value, cumulative annuity table, right? Cumulative annuity table, you have to see what is the life of the project. So 50 year, you have to see what is the location. So under how much percentage you have to find out. So it is between 3.124 and 3.199. 3.214 is 16% interest rate. 3.199 is 17% interest rate. So your IRR is between 16 to 17%. So exactly how to calculate? It is called interpolation. Interpolation method, how to interpolate this two ratios. That is, payback period is 3.214. Your discount factor, if you are taking 16%, lower rate of interest, if you are taking, you have to take it is plus. Higher means you have to take it as minus. Okay. So 16% plus discount factor for 16% is 3.274. Okay. 3.274 minus payback factor is 3.214 divided by what is the lower discount factor for lower interest rate and higher interest rate. So lower interest rate is 3.274, higher interest rate discount factor is 3.199 into the difference between these two ratios, that is 16 into 17. So 1%. So if you are taking higher interest rate, so 17% you have to deduct that what is the excess amount, right? Payback factor is 3.214 minus what is the discount factor for the 17%, that is 3.199 divided by lower interest rate and higher discount factor for lower interest rate and higher interest rate. That difference you have to find out. So you will find out what is the IRR, internal rate of return is 16.8%. Okay.
Madam, that one where how to find that one, madam?
Difference 16 minus 17 minus 16. What is the difference?
Yes, madam.
1%. Suppose here 16%, here 18%. Here you have to write 2. 16, here 20, 4. The difference between these two interest rate. Okay.
So
Okay,
according
madam.
to the table, it is possible, right? The interest rate can
Possible.
be.
Possible.
Okay.
Okay. Can we go for next one? This IRR and NPV, most of the question paper, if you see, 20 marks case study they have given. Okay, so IRR and NPV is very, very important thing. In the examination, you can get the annuity table from your examiner. You can get it and see. Okay. Next one, let us see profitability index method. Profitability index method, it measures the present value of returns per rupee invested. It is very simple. NPV, what you are doing? Present value of cash inflows minus present value of investment. That is net NPV, net present value. Here, what you have to do, profitability index, the present value of cash inflows divided by present value of initial investment. That is called profitability index. Instead of deducting, you are dividing. So per rupee, if you are investing, what is your present value of cash inflow? That is ratio. You are finding the ratio. That is called profitability index method. Okay. Acceptance or rejecting rule. That is this project, which project gives you profitability index exceeding 1. That means what? Your cash inflows 200 rupees. Say for an example, 200. Your cash outflows is 100. So it gives you 2. So it is a profitable one, right? You can accept. Suppose your cash inflows are 100. Your cash outflows are 200. That means what? It is less than 1, 0.5. That means that there is no profitability, right? So you have to reject that project. Okay. So profitability index acceptance rule is greater than 1, right? See this problem. A project will qualify acceptance machinery A. Yes. Machinery A, cash flows 75, inflows 75,000, its present value 50,000. So what is the present payback profitability index? 75,000 present value of cash inflows divided by initial investment 50,000, that is 1.5 times.
1.5 times.
So it is acceptable. It is good. Okay. Machinery B, present value is given 1 lakh. Present value of outflow is 50,000. So profitability index is 2 times.
Two
So
times.
both the machinery are giving cost more than 1. Profitability index is more than 1. Both are acceptable, isn't it? But when you go for mutual exclusive decision making, so which machinery will you decide?
Mission B.
Machine B. Machine B gives you higher profitability index. So we can take decision making according to profitability indexes, which gives you greater profitability index. Right? That's all these methods we have studied. All together, I do one more problem in this. See, let us do one problem which is covering all these methods. Okay.
Voice is breaking, ma'am.
Yes. Yes,
Voice is
something.
breaking.
Your voice is breaking, ma'am.
Understand. Any one of you speak at the same
Voice
time.
is breaking, ma'am. Anyone is unmuted.
Voice breaking.
Yes.
Mr. Vamshi, please mute your mic. Mr. Vamshi.
Okay, mute your mic. You can get clear. Vamsi, you mute your mic. Can you clear? Let us do one problem. Adjusting all these methods. See this. A limited company is considering investing in a project requiring a capital outlay of rupees 2 lakhs. Forecast for annual income after depreciation. You have to watch it after depreciation, but before taxation is given for first year 1 lakh, second year 1 lakh, third year 80,000, fourth year 80,000, fifth year 40,000. Depreciation may be taken as 20% on original cost and taxation 50% on your net income. You are required to calculate, evaluate payback method, return on invest ARR method, then discounted cash flow method and NPV. See here. First, let us see some workings. So first year, this is profit which is given annual income after depreciation but before taxation. First, you have to calculate taxation. You have to eliminate the tax. Okay. So this is profit after depreciation. Depreciation is already deducted, right? So now you have to calculate taxation, that is 50%. 1 lakh into 50% taxation, that is after taxation is this is the profit. 50,000, 50,000, 40,000, 40,000, 20,000, right? So now for calculation of NPV, I already told you the profit which is to be taken after taxation but before depreciation. So depreciation, it is already deducted. So now we have to add back to the cash flows. What is the amount of depreciation? How to calculate? See, the investment value is 2 lakhs. What is the estimated life of the project? Estimated life of the project is not given, but it is given 20% on your original cost. So 2 lakhs into 20%, how much? 40,000 for 5 years. So straight line method, if you divided by 5 years, that is 5 years. So 2 lakhs divided by 5 years, that is 40,000. Your depreciation amount is 40,000. So now you add with the profit after taxation plus depreciation. So profit after taxation before depreciation is 90,000, 90,000, 80,000, 80,000, 40,000, right? So now you have to take the discount factor. Discount factor, which is given 10%. 10% discount factor, that is 0.909, 0.826, 0.751, 0.683, 0.621. This is the discount factor at 10%, annuity value. Okay. So now we have to calculate what is the present value. Present value, that is 90,000 into this discount factor. You have to calculate. This is the total present value, right? Let us calculate one by one. First one, payback method. Payback method, what is the formula? What is the cash inflows divided by
Annual
initial
investment divided by annual cash flow.
Annual cash flow. Here, your cash flows are uneven. If it is a even one, 2 lakhs divided by 1 lakh means you can take 2 years, right? So now let us take profit after taxation and before depreciation value. So how many years? If you take cumulative cash flow, cumulative cash flow means 1 lakh first year 90,000, second year 90,000. So 2 years 1 lakh 80,000. How much is required now? Your investment is 2 lakhs. So 20,000 is remaining, right? So 2 years plus 20,000 divided by third year, you are earning 80,000 for whole year, 12 months. So 20,000 divided by 80,000. So how many? Yes.
Madam, in the table year 5, the profit after taxation before depreciation
Yes.
is 50,000, right?
Profit after taxation is 50,000. Depreciation you have to add back. Before depreciation means what? You have to adding 50,000 plus 40,000. You are adding.
So in the year 5,
right number is telling arithmetic adding 20 plus 40 should be 60,000 in the PATBD in the 5th year. It is typo error.
5th year should be
50,000 is profit after taxation and depreciation, right? For cash flow,
5th year, madam. Please take the 5th year. 5th year, ma'am. 5th year is.
Sorry. Some calculation mistake.
And how we got the
Wait. Error. It is error. Yeah.
And the discount factor also, madam. I have a doubt.
0 I put. Right. So 40 plus 20, 60, right? Yes, right.
And madam, how we got that 0.909 with the discount factor 10%? Can you explain it again?
This one.
This are you told in the annuity table, no? Last
Annuity table.
sometime ago,
Annuity
madam was
table,
telling that.
10% you have to see. See in the table. Table value it is given.
Okay, okay. Thank you.
So this value is wrong, I think, right? 60,000 into, just a minute, I calculate it. Last year we have calculated wrongly. 60,000.
37,260.
60,000 into 0.621. So, correct? 37,260 is correct,
It
right?
is
Yes, ma'am.
260. Oh, yeah.
37,260.
37,260.
Yes, 260.
Yes.
So now you total it. Total is correct, huh? No. Total is 81,819 plus 74,376 plus 60,104 plus 54,640 plus 37,260. So 3 lakhs
3 lakh
198.
8,199.
3
Yes,
lakh
yes, correct.
8,198.
Okay.
So,
Okay, so payback period 2 years plus 20,000 divided by 80,000. We can say 2.25 years. That means 3 months. Okay, 2.2 years, 3 months. That is the payback period. If you are taking this profit after taxation but before depreciation value, if you are taking as it is value, 2 years. Okay, see here. The next one, average rate of return or accounting rate of return method under original invest. Both the methods they are asking. Original investment method or average investment method. Original investment method is nothing but you have to take 2 lakhs. Average profit, what is your average profit? Here under accounting rate of return, average profit you have to take only the profit which is after taxation and depreciation. This profit. After taxation and depreciation you have to take, that is 50,000, 50,000, 40, 40, 20. So totally how much it is? 2 lakhs, isn't it? So 2 lakhs divided by 5 years. What is the average profit for accounting rate of
40,000.
return method? 40,000. You should be very carefully listen. Under accounting rate of return, the profit you have to take only after depreciation and taxation. For calculation of NPV, you have to take after taxation but before depreciation. That you have to keep it in your mind always. Okay. So here average profit 40,000 divided by original investment is 2 lakhs. So ARR rate is 20%. If you are taking average investment, that is average investment means 2 lakhs divided by 2, that is 1 lakh. So 40,000 divided by 1 lakh, that is 40%. Then next one, discounted cash flow method and taking cost of capital. Discounted cash flow method is nothing but NPV. NPV already we have calculated, that is 3 lakhs 8,199. 199. Outflow is 2 lakhs.
2 lakhs.
2 lakhs. Your NPV is 1 lakh 8,199. This is the net present value. The next one is profitability index. Profitability index, that is present value
Cash flow
of
divided by
cash inflows divided by present value
cash
of
outflow.
initial investment, that is 2 lakhs. 3 lakhs 8,199 divided by 2 lakhs. So your profitability index is 1.54. So is it acceptable? Yes. Profitability index, if it is more than 1, is acceptable. So these are the methods are asked in your problem. Here, this is not NPV. Profitability index. And that is the actually they asked the NPV index method means that is profitability index method. Okay. Discounted cash flow method, it is here, it is nothing but it is NPV. Okay. Understand this, all of you? Can we go for next one, next topic?
Madam, please
Ah.
repeat one more time into some
Is
payback
it-
period method. Payback period.
Payback period, it is very simple. So if you are taking actual cash flow means 2 years. Your initial investment is 2 lakhs, right? So initial investment divided by if it is a even cash flow na, if it is a for 1 lakh per year every year, that means 2 years, right? So it is uneven cash flow. When it is uneven cash flow, you have to see profit after taxation. If you are taking first year 90,000 your earnings, second year earnings is 90,000. So totally what is cumulative your cash flows? 1,80,000 you are earning within 2 years, right? So 2 years plus how much is remaining? How much is remaining?
20,000.
20,000 you have to earn in the third year, right? So third year, how much you have earned? 80,000 for 12 months, right? So 20,000, 2 years plus 20,000 divided by 80,000. 80,000 you are earning for 12 months. How much time required to earn 20,000? 20,000 divided by 80,000. That means 3 months, isn't it? Do you understand
Yes,
or
ma'am.
not?
Yes, ma'am. Understand.
So 2 years plus 3 months. That is the payback period. Payback period, no need to take a profit after taxation and before depreciation. You can take anything. Even before taxation also you can take, that is 1 lakh. 1 lakh means 2 years. Payback period you can write 2 years. That is also nothing wrong in that. So if you are taking, considering this taxation, you can take this calculation. But NPV, while calculating NPV, you should be very careful. The estimated cash flow should be after taxation but before depreciation. Once in your problem, if it is given after taxation means depreciation might be deducted. You have to add back for estimating the cash flows for NPV. Okay, that you have to keep it in your mind. Right? Then average rate of return, while calculating average rate of return, the profit should be after depreciation and taxation profit. Accounting profit you have to take. Accounting profit means what? In profit and loss account, you are calculating all depreciation, taxation, everything. That net profit is the accounting profit. Okay, that accounting profit is to be considered for the calculation of accounting rate or average rate of return. You understand this?
Yes, ma'am.
See here, the NPV calculated here. See here. Here, simply we have taken as it is what is given in the problem. Why? Here we did not added any depreciation. Why? Because the problem itself what is given, the profits before depreciation and after taxation. That means what? After taxation and before depreciation it is given. Instead of, suppose here, instead of before depreciation is not given, the profits are given after depreciation and taxation is given. Say for an example, I am saying after depreciation and taxation, if it is given like that, you have to add back the depreciation in the cash inflows. Say for an example, this 5,000 is after depreciation and taxation, right? So what is your depreciation value is 20,000 for 5 years. Scrap value deduct it. 20,000 minus 1,000. So 19,000 divided by 5 years. So what is your depreciation? $19,000 divided by 5 years. So your depreciation 3,800. So you have to add back 5,000 plus 3,800, 10,000 plus 3,800. That is profit after taxation before depreciation. Do you understand this? Suppose in your problem, instead of before depreciation, here if it is given after depreciation, means you have to calculate like that. Do you understand? This is the way we have calculated here. See, this problem, profit what is given? Annual income after depreciation but before taxation. Taxation, what is profit is required after taxation but before depreciation we require. Depreciation is already deducted. Suppose, same problem, it is given annual income. If it is given before depreciation and taxation. Before depreciation and taxation is given in your problem. Okay, so how to calculate? First you have to deduct the depreciation from this amount. Wait. Right, so this is profit before taxation and depreciation. Before depreciation and before taxation, right? So now we have to calculate depreciation. Depreciation is how much? 40,000. This is depreciation, right? This is depreciation. Now we have to deduct first depreciation. 1 lakh minus profit after depreciation. Why we have to deduct depreciation? Because for calculation of taxation, depreciation is an allowable expenditure for taxation. Okay, so now if you deduct 1 lakh minus 40,000, your profit is 60,000. So here 60,000. So here 40,000. Here 40,000. Here 0. Okay. So now we have to calculate taxation. So taxation is 50%. Right. So what is the tax? 60,000 into 50% means 30,000. Here 30,000. Here 20,000. Here 20. Here 0. Right. So now this is the profit after taxation and depreciation. Now we need profit after tax but before depreciation. Now we have to add back this depreciation. So the 60,000 is this profit after taxation is 30,000 plus depreciation you have to add. So 40,000 plus 30,000, 70,000. So here is 70,000. So here 20,000 plus 40, 60,000. Here 60,000. Here 0 plus depreciation is 40,000. You have to add the depreciation. Do you understand? So this is the profit after taxation but before depreciation. You have to calculate like this. Okay? Do you understand this? So you have to be very carefully read the problem. What is given? Annual income after depreciation, before depreciation, after taxation, before taxation. You should be very carefully read. For calculation of net present value or present value factor, you should take cash flows after taxation but before depreciation. Do you understand this, all of you? This is for example I told you. Okay. Can we go for next one? Yes, anybody?
Yes, ma'am.
Okay. Next topic is
Ma'am, on doubt.
third unit, leverage. What is leverage? Leverage means that it is an employment of an asset or fund which the firm pays a fixed cost and fixed return is called as leverage. The employment of asset or fund. Employment of asset means what? Long-term asset. Employment of fund means long-term capital. That is capital which is employed in the business, right? That is a long-term fund which pays a fixed cost or fixed interest, fixed return. Fixed cost means fixed expenditure, or fixed return means fixed rate of interest, right? So this leverage, the ability to use, we can divide into two ways. One is financial leverage, another one is operating leverage. If you take operating leverage, the company's ability to use the fixed assets we are using, what is the fixed cost earned to increase the maximize the shareholders will. Say for an example, I already explained you, if you marginal costing we have already studied in first semester. Do you remember that? What is marginal costing? What is marginal costing? Anybody, do you remember? How would you calculate marginal cost? Yes. Anybody? Anyone? First semester I taught you accounting for manager, marginal costing.
Ma'am, if I sell product 100 rupees, I add a margin plus 10 rupees. 10% or 10 rupees. I think that only is a margin.
No.
That
That is
10%.
profit. That is profit, not margin. That is
Ma'am,
profit.
the marginal costing is in addition to the fixed cost. You are adding variable cost for each one product. What is the cost
Yes,
required
very
to
good.
produce?
Correct. That is, marginal costing is nothing but additional cost for additional units produced by the company. Additional cost of producing the additional number of units. Say for an example, 100 units you are producing, right? Its total cost is 1000 rupees, right? So per unit cost is how much? 10 rupees, right? So if you are producing 110 unit, how much cost it should be? 1,100 it should be, but you are incurring only 1,040 rupees or 1,050 rupees instead of 100 rupees. That means what? Fixed cost which involves will not be vary with the volume of output. Only the variable cost vary with the volume of output. Fixed cost is constant. If you are producing more number of units, that will not increase. Okay, that is the concept of marginal costing. So marginal costing, when you are using the fixed charge of fund, you are increasing your productivity, the profitability will be more, right? That is the firm's ability to use fixed cost of assets or fund that increase the return on your shareholders. You understand? That is called leverage, right? If earnings less variable cost, yes, ma? Variable cost exceeds your fixed cost, that is earnings before interest and tax, that exceeds your fixed return on investment. That is favorable leverage. That we can divide into two types, that is operating leverage and financial leverage. Let us see what is operating leverage. Operating leverage is associated with the investment activities. That is the company's ability to use fixed operating cost to magnify the effect of changes in sales on its earnings before interest and tax. What is operating leverage? The company's ability to use the fixed operating cost. Fixed operating cost means what? When you are increasing your productivity level, now present level you are using 50% is your capacity is 100%, but present level you are utilizing only 50% of level of productivity. You are producing 1000 units, right? If you are increasing your productivity 2000 units, so how much profitability you can earn? Fixed expenditure which is incurred for producing that product will be constant. If you are producing 1000 unit or 2000 unit is whatever up to the level of capacity, 100% level of capacity, it is constant. Even if you are producing 1 unit of output or 10 unit or 100 unit or 1000 unit or 2000 units, whatever it is, the fixed expenditure what you are incurring, it is the constant, but variable cost is vary with the volume of output. Okay, so the company's ability to use the maximum productivity, so your earnings will be maximized, isn't it? Do you understand that? That is the operating leverage. Operating leverage is what? The company's ability, this is the thing. Company's ability to use fixed operating cost to magnify the effect of, how it will magnify the effect of changes in sales. Sales will increase, isn't it? When your productivity will increase, sales automatically will increase. When you are increasing sales, your earnings will also be increased, isn't it? So earnings will increase. That is called operating leverage. The formula of operating leverage is contribution divided by operating profit. Operating profit is earnings before interest and tax. What is contribution? Contribution means what? Sales minus variable cost. That is
Variable cost.
contribution. So contribution divided by operating profit, that is earnings before interest and tax, that is called operating leverage, right? We have to find out what is the degree of operating leverage. Degree means how much percentage will magnify the profit. So the percentage change in profit divided by degrees of leverage, operating leverage is percentage of change in profit divided by percentage of change in sales. This is the degree of operating leverage. Let us see the one problem, we will understand. See this problem. Company A, company B, its sales is 25 lakhs, 30 lakhs, fixed cost 7 lakhs 50,000, here 15 lakhs. Variable expenditure in the as a percentage of sale is 50% company A and 25% for company B. Let us calculate what is the contribution. Sales is 25, 30. Variable cost is 50%. 50% means 12 lakhs 50,000. Here 25% means 7 lakhs 50,000. What is the contribution for company A? 12 lakhs 50,000. Company B 22 lakhs 50,000. Fixed cost in case of company A is 7 lakhs 50,000. For company B is 15 lakhs. So operating profit is earnings before interest and tax. That means you have to deduct the fixed cost. Contribution minus fixed cost is operating profit. In case of company A is 5 lakhs, company B is 7 lakhs 50,000. So what is the operating leverage for company A? 12 lakhs 50,000 contribution divided by 5 lakhs is the operating profit. So operating leverage is 2.5 times. So for company B, 22 lakhs 50,000 divided by operating profit is 7 lakhs 50,000. So operating leverage is here 3 times. So what is your decision making? Which company's operating leverage is higher?
Operation company B.
Company B. So which company B is having higher degree of risk also? Risk as well as higher degree of profitability also, isn't it? So when your company B, if you are choosing company B, if has to increase their sale, instead of 30 lakhs, if it goes for 40 lakhs or 50 lakhs, definitely the profitability will be greater instead of company A, isn't it? Company B, fixed cost is greater than company A, 15 lakhs fixed cost. So when your productivity or sales, when you are increasing, automatically the profitability will be greater in case of company A. Risk is also involved. So which company or which project operating leverage is greater, that is more profitable project or company, right? You understand this? This is operating leverage. So here, when you are fixed, company's ability to use fixed cost, right? Fixed cost or fixed fund utilizing your asset that magnify your revenue or sales. Magnify, what is magnifying? When you are magnifying your sales, the profitability will be greater. Do you understand the operating leverage? What is your operating leverage? The company's ability to use fixed operating cost to magnify the effect of changes in sales. When you are increasing the sale, its earnings before interest and tax will increase. Isn't it? Do you understand this now? What is operating leverage? Operating leverage means the company's
Company's
ability
ability to use
the
fixed
fixed cost,
operating cost to magnify.
operating cost, fixed cost, right? Our ability to use fixed operating cost to magnify. What magnify? Magnify means increasing. So
Profit.
magnify the effect of changes in sale. When you are increasing your sale, magnifying means increasing the sale, your earnings will also increase. That is wealth maximization. You understand? So that which will reflect in the financial leverage also. So what is financial leverage? I tell you, explain you. See here. What is financial leverage? Financial leverage, it is concerned with the financing activity. So I already explained you, there are various sources of financing. That is equity share capital and
Retained earnings.
don't take only two types. What is one as equity and then debt equity. Debt equity. Okay. So debt capital, you have to pay only fixed charge, fixed interest rate, right? One as
Yes.
equity, you have to pay what is the earnings, whatever earnings generated after payment of interest and taxation, that will go to shareholders. Okay. So now this financial leverage is concerned with what is the relationship between earnings before interest and tax, that is EBIT. We used to say earnings available to what is the operating profit before interest and tax, and it is what is the earnings per share, earnings available to the equity shareholders. So financial leverage is what we are saying here, the firm's ability to use fixed financial charges. Fixed financial charges, it means debt capital. Okay. When you are using the debt capital, which magnifies the effect of changes in earnings before interest and tax, which gives you the maximum benefit to the shareholders. That is earnings per share. The effect of increasing the earnings per share, right? The firm's ability to use the fixed financial charges. When you are using the debt capital, when you are using that, it will magnify means what? Increasing the level of earnings, changes in the earnings, earnings available to that is before interest and tax, that is profit. When your profit increasing, that will change or increasing the level of profit goes to equity shareholder, that will increase. That is called as financial leverage. Okay. The use of long-term fixed interest bearing debt and preference share capital along with share capital is called as financial leverage or trading on equity. That is called as trading on equity. What is trading on equity? Trading on equity is nothing but financial leverage. That means the firm's ability to use fixed financial charges to magnify the effect of changes in EBIT on the earnings per share. Okay. Let us see this. We will understand this formula for financial leverage. Operating profit, that means earnings before interest and tax divided by earnings available to equity shareholder, or we can say it is a earnings per share, or profits available to equity shareholders. This is earnings available to equity shareholders, or this EBIT you deduct interest. that is called interest, that is called earnings available to equity shareholders. So the degree of financial leverage is formula percentage change in earnings per share divided by percentage change in earning EBIT, earnings before interest and tax. Let us do one problem, you will understand here. Equity share capital 1 lakh, 10% preference share capital 1 lakh, 8% debentures 1,25,000. The present EBIT is 50,000. Calculate financial leverage, assuring the company using 50% taxation. Right? So earnings before interest and tax, it is given in your problem. EBIT is 50,000. Right? What is your interest? You have to pay to your debenture holder. Debenture holder 8% on your 1,25,000. How much it is interest? 1,25,000 into 8%. Interest you have to pay for your debenture holder is 10,000. Okay.
10,000.
10,000. So earnings before, after interest, but before taxation is 40,000. Right? What is your taxation? 50%. So 50% taxation, that is 20,000. You deduct it. What is the profit? Earnings after interest and taxation is 20,000. So now financial leverage formula. What is the formula? Operating profit
divided by
before interest and tax divided by earnings per share or earnings available to equity shareholders. Right? Profit EBIT is 50,000 divided by earnings available to the equity shareholders, that is before taxation, that is 40,000. So what is your financial leverage?
1.25.
1.25. So this is the financial leverage, right?
Okay, ma'am.
Let us see. So which suppose two proposals are given, two capital structure format is given. So which which capital structure gives you more financial leverage? Which involves more financial risk, but at the same time more wealth maximization. That is earnings available to earnings per share to the shareholders will be greater. Okay. See this combined leverage. Combined leverage means the effect of using financial operating leverage, that how it will reflect in your financial leverage. See this problem. That is combined leverage is called operating leverage into financial leverage. That is combined leverage. See this problem, you can understand this. Kumar company sales is 25 lakhs, variable cost 12 lakhs 50,000, fixed cost 50,000, and the debt is 12 lakhs 50,000, 8% rate of interest. First, let us say calculate operating leverage and then financial leverage. Sales is 25 lakhs less variable cost, which is given 12 lakhs 50,000. Fixed cost 50,000. Sorry, I have done mistake here. $15 lakhs. Variable cost is 15 lakhs. Okay. Variable cost 25 lakhs is the sales. Variable cost 15 lakhs. Contribution is 10 lakhs. Fixed cost 5 lakhs. Fixed cost 5 lakhs. That is operating profit is 5 lakhs. Okay. Contribution is 10 lakhs. So what is the operating profit? Sorry, operating leverage formula? That is contribution by EBIT. What is contribution? 10 lakhs divided by EBIT, earnings before interest and taxes. That is operating profit is 5 lakhs. So operating leverage is 2 times. Okay. Financial leverage, that is EBIT divided by EBT. That is earnings.
1.25
is to 5 lakhs. Okay. Interest you have to deduct from this. Interest is 8% on 12 lakhs 50,000. So 12 lakhs 50,000, that is 1 lakh deducted. So 4 lakhs. Before taxation, that is 4 lakhs. So financial leverage is 1.25. So combined leverage is 2 times operating leverage into financial leverage, that is 2 into 1.25, that is
2.5.
2.5 times. This is the combined leverage. Suppose operating leverage, when you are using increasing your sales, increasing, that is 25 lakhs to you are increasing 50,000. Right.
Madam, please, you can a little bit zoom it.
Wait. Here, sales instead of for 25 lakhs, you are making double, 50 lakhs. So here, variable cost how much? Will also be double, 30 lakhs. Okay. So what is your contribution will be? 20 lakhs.
20.
But fixed cost will be the same. It will not
Remains
increase, 5 lakhs only. So what is your operating profit here?
15.
15 lakhs.
15 lakhs.
Okay. So now operating profit is 15 lakhs. What is your operating leverage here?
Contribution by
Contribution is
MBA.
20 lakhs. Here, contribution is 20 lakhs. Your operating profit is 15 lakhs. So how much it is? Don't wait. Now, no need to calculate this financial leverage. So, when your financial leverage is higher, when you are increasing, magnifying your sales, the earnings before interest and tax, that is operating profit, is increasing. Previously, how much it is? Only 5 lakhs. Okay. Now, your operating profit is magnifying. How much is magnifying? 10 lakhs is
10
more.
lakhs.
Right? 15 lakhs you are earning. Right? So, when you are using the fixed cost, company's ability to use fixed cost, increasing, magnifying or increasing your revenue sales, your that will increase your operating profit, that is earnings before interest and tax is increasing. Okay, this is the operating leverage. So when your operating profit in increasing, that will reflect your wealth maximization. How it will reflect? Your financial leverage, that is, say for an example, here operating profit now it is 15 lakhs. Okay, your what is your interest? Same, only 1 lakh. So your operating profit is 3. So instead of 4 lakhs, you will get 14 lakhs, isn't it? $14 lakhs. So what is your profitability earnings available to equity shareholder? It will increase. Instead of 4 lakhs, it is 14 lakhs. It is magnifying, isn't it? Do you understand or not? When
Yes, ma'am.
when your sales are increasing, the ability to use the fixed chart, magnify the sales, that will reflect your wealth maximization. Wealth maximization means what? Earnings available to equity shareholder will increase. That is 14 lakhs. Instead of 4 lakhs, it is 14 lakhs. So automatically the share value of your company will increase. Do you understand this concept?
That is, earnings per share will be increasing.
Yes. That is net worth value of your company. When it is increasing, automatically the share price will also increase.
Yeah.
Isn't it? Wealth maximization.
Ma'am, please do this slideshow now. We can't see.
Wait. In slides, so I couldn't do any editing work. That's all. Right? So here, 25 lakhs when your sales, the profit available to equity shareholder is only 4 lakhs. Okay. Your financial leverage is 1.25. Right? So when you are magnifying the company's ability to magnify your sales, instead of 25 lakhs, 50 lakhs. So operating profit will be 15 lakhs. That will reflect in your shareholders' wealth. How it will reflect? Instead of available equity earnings available to equity shareholders, previously it was only 4 lakhs. Now it is 14 lakhs. The entire profit goes to your shareholders. debt to capital, you have to pay only the same 1 lakh what you are earning. What is the fixed rate of interest? Do you understand this? So this is the leverage, right? So let us see what are the uses of operating leverage and financial leverage. Operating leverage is one of the technique to measure the impact of changes in sales which lead to change in profit of the company. Once the changing the sales, that will reflect in your change in profit. If there is any change in sales, that will lead to corresponding changes in profit. That is, operating leverage helps to identify the position of fixed cost and variable cost, right? Operating leverage, which measures the relationship between sales and revenue of the company during a particular period. Operating leverage helps to understand the level of fixed cost which is invested in the operating expenses of business activities. Operating leverage describes the overall position of the fixed operating cost. So these are all the uses of operating leverage. Financial leverage, which helps you to examine the relationship between operating profit and earnings available to the equity shareholder. That is EBIT and EPS. EPS means earnings available to the equity shareholders. Financial leverage measures the fixed percentage of change, some percentage of change in taxable income to percentage change in EBIT. Financial leverage locates the correct profitable financial decision regarding capital structure of the company. So financial leverage, which is very helpful for taking decision making, the sources of capital or capital structure. Financial leverage is one of the important devices which is used to measure the fixed cost proportion with the total capital of the company. And if the company acquires fixed cost funds at a higher cost, then the earnings from those assets, earnings per share, and return on equity capital will decrease, right? So you should be very careful while selecting the operating leverage and financial leverage. These two leverages which helps to take determine for capital structure decision making as well as your capital budgeting decision making. Okay, so your examination point of view, they may ask you what is the differentiate between operating leverage and financial leverage. Listen, I already explained you so many points. So I have given here operating leverage is associated with the investment activities. This is associated with financing activities. This is consists of fixed operating expenditure. This is consisting of operating profit of the company. This is ability to use fixed operating costs. This is relationship between the ability to use fixed financial bearing sources. That is difference between EBIT and earnings per share. Here calculated contribution by EBIT. Here EBIT by earnings available to equity shareholders. This is a percentage change in profit that result in percentage change in degree of operating leverage, say change in sales. Here percentage change in taxable profit that will reflect your profit changes in your earnings available to your equity shareholders. This is called as operating leverage is called as trading on equity is not possible, but here we can say this is trading on equity. Here operating leverage depends upon fixed cost and variable cost. Here depending upon the relationship between equity capital, debt to equity mixture. Here tax rate and interest rate will not be affect the operating leverage. Here financial leverage will affect your interest rate. Suppose interest rate, if it is greater, that reduce your earnings available to equity shareholders. These are the differences between operating leverage and financial leverage. That's all with regards to this chapter. If you have any doubt, you can ask me. So now,
Madam, when will you upload the PPT in website, madam?
Next week we will upload. Don't worry.
Madam, please add that present value table in this PPT, madam.
PPT we can take from Google. You search, it is available. Internet it is available. Annuity table, if you put, it will be available. It's difficult to add. It is in PDF form. Difficult to add in PPT.
And it is there in all financial management books also. You can take any book.
Statistics, any statistics, that annuity table book, it is available. You search in Google annuity table value. It will you can get it easily.
Yeah, ma, we can.
Okay. Then any other doubts?
No, thank you.
Okay, can we wind up this class now?
Sure.
Okay, thank you.
Yes, ma'am. Thank you.
Okay, thank you.
Thank you, ma'am.
Thank you, madam.
Thank you, ma'am.
Yeah, good afternoon to all of you.
Good afternoon,
Good
sir.
afternoon, sir. Good afternoon.
Yeah, shall we start our class?
Yeah, yes, sir.
Yes, sir.
Yeah, today we will again. Are you able to see my screen?
Yes, sir.
Yes, sir.
Yes.
Yeah. We are going to discuss once again, marketing management, isn't it? So
Yeah, yes,
in
sir.
our earlier classes, we have 2 classes. We have discussed about basic concepts in marketing, unit 1. Then product something we have discussed, isn't it? Quickly, I'll go through what we have discussed earlier. For the newcomers, those who have joined today, they can have little bit idea that in first class we have discussed about basic concepts of marketing. Exactly what marketing is. Marketing to identify the need of the customer and to make a product, quality product, value-added product, to provide them value for their money and to satisfy each other, satisfy the customer as well as marketer also, those who are making the product. by giving the earning profit and by giving satisfaction to the customer as per their requirement, and to create continuous relationship. And you must remember one or two definitions which we have already given. I'll at the end of the class I will share the PPT with you also, so you can prepare. Next we discuss about the basic concept or orientation of marketing, or you can say era of marketing or history of marketing. Like we have discussed about you can say production era, product era, then sales era, marketing era, societal era, and also you can say that relationship era. Those we have discussed. Then we discuss about the marketing environment, different kinds of environment. Like whenever you are doing business, some kind of environment will be associated with it. So those are the internal environment and external environment, or macro environment. You can say the internal environment, like which is within you, like your shareholders, your employers, then your suppliers, all this internal environment. External environment which are beyond your control, like we discuss about demographic environment, like socio-cultural environment, political environment,
Economic,
technological environment,
technological,
economical environment, all this kind of
economic.
environment we have discussed, which are major environment and which are not under your control. You need to face such kind of environment. You have to adjust as per that and do your business. Then we discuss about marketing mix. Marketing mix or traditionally what you called as 4 P's of marketing: product, price, place, and promotion. Yeah, and other 3 P's in case of marketing services, because product is not only goods, it is also services. So when you include services, other 3 P's are also essential. What are those? Like people, process, physical evidence. And some of the authors, they write 8 P's also, like packaging. Packaging also one of the part of it in P's, because packaging nowadays it is taking lots of importance, innovative kind of packaging, like Tetra Pak, the Zip Pack. So all these different kinds of packaging, innovation in packaging, because once packaging is good, it attracts the customer. So it contains a lot of things like information, then attraction, then product variation. All this is contains the this packaging. So you can write, if your question comes, so what is marketing mix? You write 4 P's and additional 3 P's also. Or exceptionally, if you are being asked for explain 4 P's of marketing, you can write product, price, place, promotion. Then we discuss about the market segmentation, targeting, position, STP, which is very much important. Segmentation, targeting, position, in the sense you need to segment the market. Which segment you need to offer your service. Then you need to, out of that segment, you need to target the people. Who are the target? Suppose Pondicherry is the, you are segmented out of India. Pondicherry is the place where you want to do your business. Then targeting, who are the customer for you, whether male, female, or child, to whom you need to target. Then you need to position your product in such a way, the moment the customer they want your product, it should come to your mind. That as I gave your example, the Maggie, the moment you think about the noodle, Maggie comes to your mind. The moment you think about baby soap or baby product, the Johnson, it comes to your mind. Similarly, soft drinks, like this is the right choice baby. Whenever you require soft drink, the Pepsi gives the advertisement that it is the right choice baby, like in Canada. Similarly, you can say the celebration. Celebration, which company? The chocolate, Cadbury's. Celebration, you must have, whenever there is a celebration, you need such kind of product. So they place the position of product in such a way that you will think about that kind of product only. So this is in nutshell, this is the unit 1 we discussed. So at the end we will share the PPT also, so that you can make use of it. Then we discuss about the very important thing, differences between selling and marketing. So you can write some 5-6 point differences. So we have discussed elaborately. Then this 4 P's of marketing, demographic, buyer behavior. We have discussed about the buyer behavior. What are the different types of buyer behavior? What are the determinants of consumer behavior, like culture influence, group influence, family influence, unique motive, perception. These are influencing to the consumer behavior. Next, we discuss about the consumer decision process, like problem recognition, next stage in information search, evaluation of alternative, then purchase decision, and post-purchase decision. Already we have discussed. And now unit 2, we have discussed the basic concept of product label, product clarification, brand decision. Now today we will be discuss about product life cycle and new product diffusion and innovation diffusion. So these three things we'll discuss, which are very important in this unit. So product, we have discussed what is a product. Product can be a goods, can be a services, can be idea. It is a bundle of satisfaction, isn't it? So when you need something to fulfill your requirement, so product, by taking the product, you need to get satisfaction. So product is not only consisting of the physical product, it is associated with other things also. Like for example, if you are buying a television set, so television is the physical product, and other things like transportation and the services, cable services, all these are part of it. So product can be associated with many things, like refrigerator. Not only the it is having the size, it's a door, it's a color, the fan, gas inside it. All these are part of it. So next we discuss of the basic product labels. What are the different product labels? Like we discussed the core product, then the generic product, branded product, augmented product, then customized product, potential product. All this we have discussed. And next one was product classification of the product, like consumer durable product, consumer non-durable product, industrial goods. All this we have discussed. In durability, non-durable, durable goods, services, and consumer goods, you can say convenience, shopping goods, specialty goods, and short goods. Similarly, industrial goods, material and parts, small parts, capital item, big item like machineries, supplies, and business services. Now also we discuss about the brand decision. What is a brand? A collection of perception in the mind of the consumer. When you think about a brand, about a product, the brand immediately comes. If you want to buy a product, immediately it comes that sophisticated soap. It came to your mind that Dove. Like this, the brand plays an important role. Brand gives to the legal protection to the product also. Similarly, now we will discuss about the product life cycle. So, which is a very important concept in product. We also discuss product mix, product length, product breadth, product width. Any kind, if you have any confusion at the end of the class, we can discuss. Okay. Shall we proceed further? These are the things which we have discussed in earlier classes. Shall we proceed further?
Yes, sir. Yes, sir.
Yes.
Yes, sir.
So we'll go for now product life cycle. You see, like a human being travel through the different phases. Similarly, a product has different stages also. It travels through, all the product has to travel through different stages in their life cycle, which is called as product life cycle. So there are basically there are the 4 phases. Like one is marketing pioneering stage, or you can say introductory stage. Second is market growth stage, when the product at its maximum growth, sales are high. And next is maturity stage, when products get maturity and customer wants to some change in that kind of product. So that is the maturity stage. Now, next is market decline stage, when the product falls, when declines, when no more customer likes your product. So you can see that in this graph, there's a S curve. It is called as S-shaped curve. Initially, the introduction stage, then growth stage, then maturity stage, and decline stage. Introduction stage, when you introduce a product, new product in the market. It's a completely new, or it can be a modified product. So it is an introduction stage. In this stage, you need to think about all the 4 P's of marketing, or all the 7th P's. Like 4 P's is in there, you need to think about the product, price, place, and promotion. Because here you are launching a new product. It should be innovative product or differentiated product. Otherwise, plenty of similar kind of products will be available in the market. Until unless you have some kind of differentiation or specialty in your product, it will not work out. So we have seen that it is, the research has seen that more than 70% product fails in the market. Why? What is the reason? There may be various reasons. We'll discuss in the later stage. Now you understand what is the introductory stage. In this case, the product is introduction stage. The product should be a differentiated product, or special some specialty will be there in your product, or quality product has to be there with respect to your competitor. Then what is the price? Price wise also, it should not be too high so that customer will not be able to buy your product. So it should be reasonable price with your competitor, and there's a pricing method like skimming pricing and penetrating pricing. 2 kinds of pricing while launching a product. Skimming pricing in the sense when you have the product of some special kind of product or some innovative kind of product which is different from other products. In that case, you can go for skimming pricing. Skimming pricing in the sense you will charge very little bit more than normal price, so that you can earn the profit in the initial stage. Not only earning profit by charging heavy price, but satisfying the customer by giving them innovative product. Similarly, distribution wise also, it has to be available in the market. Distribution process has to be taken care. Until unless it is distributed in the market, it is supplied to the market, customer will not be available, will not be able to get the product, because customer are ready to pay, but they need to get the product at their doorstep or at their convenience. Similarly, promotion will be very low because it's a new product. You need to give importance to your promotion, to inform your customer. Until unless your customer is informed, then they will not come to buy your product. So you need to communicate to the customer or target customer about your product, that so and so kind of product, such as the price of the product and quality of the product. All this it is need to be conveyed to the customer by different methods like sales promotion, advertising, public relation, personal selling. All this method you can adapt for. Here in this case, you may go for profit or very little profit, or may go for negative profits also, because lot of things you need to spend here for distribution, production, promotion. All these things you have to taken care. So lot of price you have to be invested. You have to invest in this one. So profit may be lower because it is a introduction stage. Next stage is called a growth stage. Growth stage in the sense, this is the stage where people are aware of your product, about the quality of your product, price of the product. Now they have started accepting your product. It will go to the growth stage. It will grow, and you will earn a high profit in this one, and revenue will be higher. Then next stage comes the maturity stage. When maturity stage comes, the people will be fed up with the similar kind of product. They need some kind of changes. Like for example, earlier you are using cell phone with keypad. Then later on, customer are saturated with that one. We need something new, touch screen. So later on, you must have seen that plenty number of varieties were available in the market touch screen brand. So similarly, on scooter or bike, drum brake. Earlier it was drum brake, and then they want some kind of innovation in that one. Again, it came to disc brake. Now you can say the varieties of vehicle with disc brake system. So you need to be innovative. Otherwise, without innovation, it will not work out. Your product will go to the decline stage. You need to kill your product. Otherwise, it has to be some kind of innovation has to be there to remain in the market. You must be remembering like cars like Padmini. In India, there is a Padmini car, but now it is not there. Because so when people like to modify the product, the company could not modify its product and it has gone to the decline stage and built the product. So you need to take care when it is in growth maturity stage, some kind of innovation has to be there. Like you must have seen that same product, they will change the packaging, color, size or something they will change, bring some kind of innovation so that again customer will buy the product. You must have seen that in some of the product, when it goes to the decline stage, they make some changes and they will do some kind of promotion like buy one get one, or buy one product get another product, buy Tata salt get along with buy Shakti Bhog atta along with you get one packet of salt free. Like this, they want to again make their customers so to remain in the life cycle for longer period. So I will give you one story or example of ITC brand, how to survive in the product life cycle. ITC, have you heard about the company?
Yes,
I
sir.
need response from your side also.
Yes, sir.
What is that
Yes.
ITC? What is the full form of ITC? That company.
The Indian Tobacco Company.
Indian Tobacco Company.
What it does now? Indian Tobacco Company.
Earlier it was into the cigarettes, but now it has to diversify into consumer goods also.
Yeah, earlier it was selling cigarette, and he was the ITC was the one of the pioneer company to launch cigarette in the Indian market, isn't it? So now, as per the requirement of the customer, it has been diversified into the market, which are many consumer goods and other quality of products. Even ITC hotels are also there, right? So ITC was the Indian Tobacco Company in Indian market in 1912. The company was launched into the market. Cigarette company brand name is Caesars. Have you heard about Caesar brand cigarette? Those who are in habit of smoking, they might be knowing. Otherwise, also many people they might be knowing that Caesar brand was there launched in Indian market. So ITC company launched cigarette brand name Caesar when there was no brand of cigarette available in the Indian market. By the time people are in the habit of tobacco, hookah, chillum, cigar, BD, etc. They were in habit of consuming those kind of products. There was no like branded cigarette in the Indian market. So Caesar company launched first time in Indian market brand name Caesars, and it became the generic product. Now you understand what is generic product. We discussed during product generic product. What do you mean by generic product? Anyone? So we discussed what is generic product. Generic product means the sense whenever you use
basic features of the products. Yeah.
Yeah, like you want sugar.
Yeah.
Give
like
me half
I
kg
want to
sugar.
travel
It's
in
a
the
kind of generic
motor
product.
which takes me from one place to other.
Yeah. Other thing like some product like Colgate, Surf. Do you remember? All these become the generic product. Instead of asking toothpaste, people were asking earlier. Now there are a lot of varieties are available. Not many companies are there. Earlier, people used to, if they need toothpaste, they will ask that give me Colgate. So it became generic product. Similarly, if you ask washing powder, earlier people used to call give me Surf. So it was so generic that it is common that because there were no more competitors, so they were forced to remember all this only Surf company, Colgate, like Xerox. These are the very generic become generic. Similarly, the Caesar brand cigarette became generic product because if you want cigarette, only Caesar brands are available. No competitors are there. So what they did when they launched the cigarette in Indian market, so they used to travel with like camel and horses to distribute the cigarette to the consumers, to make the awareness among the consumer about their product. Then it became the very one of the prominent brand in cigarette market. People started accepting the smoking of cigarette. They left BD, hookah, chillum, all those things, and they started stylishly. They started smoking cigarette, Caesar brand, and it reigned for the market for longer time up to the 1930. It was going on. It was the king of the market, and later on in 1940 or somewhere early 1940. This one more golden tobacco company launched its product, like brand name Panama. Have you heard about Panama cigarette?
Yes, sir. Its key tag was "Aakhri kas tak mazedar."
Yeah, Panama cigarette, and that you can remember that picture also. A navy person will be with hat, will be sitting navy cut, Panama navy cut. I still remember that picture in the packet. It was common in market. When Panama launched in the market, this Caesar brand, it got affected. So Panama launched the product in very rigorously in the market, give the competition to the Caesar brand, and slowly Panama gained market and Caesar has gone down. So now it has gone to the Caesar cigarette has gone to the declining stage, and Panama has gone again into rank. Then again, what he did, Caesar cigarette, whether to kill the product or again revive the product. He thought it will be revival with the best way. Then they revived the product and they launched the product in different. Panama what cleverly did. So he played the emotional game. What is that? Smoke Swadeshi, Indian product, boycott foreign product. So emotional, people who are emotionally attached, and Swadeshi means Indian product is Panama and the foreign product is Caesar. So people started accepting the Panama brand. So it has gone, the Caesar brand has gone down. Again it revived. What it changed, the campaign, he changed his campaign Caesar brand. Action satisfaction. In action, if you smoke cigarette, you will get satisfaction. Like this, again it has changed the campaign and slowly it has come to the market again. Once again, during, you can say, after some time, some other branded product, cigarette brand, they launched in the market. Around 1950, some other brands came into the market. By the time, both of the companies, Caesar and Panama, they faced competition. And once again, it was Caesar company was going to declining stage. Again, it has revived its product and modified its product, and again it remained in the market. So what I mean to say is that you need to, who are manufacturing product, they need to understand the different stages of life cycle. Which stage your product is, what is the status of your product, and whether to give lift to the product or to kill the product. It is up to you. So if you are not able to revive the product, it will automatically will kill. You must be remembering Ambassador car. All the minister time was there. All the ministers were having white color Ambassador car. But do you see in the market now Ambassador car? It is not there. Why? Because they could not revive the market as per the requirement. They could not modify the product and they killed the product, isn't it? So similarly, I was talking about the this Kodak camera. Kodak camera was failed in the market. Then other entrant, they came to market like Sony, Nikon, Canon. They entered the market. Kodak could not launch the product in time, the digitalized product. Now also Kodak is tackling in the market. So these are the different stages of life cycle, and you need to understand what are the different stages and what are the strategy you need to develop. In introductory stage, you need to, what strategy you need to do about the 4 P's product, how will your product what is the pricing, what are the distribution pattern, what are the promotional pattern. All this you need to take care. Again, in growth stage, what you need to do here, already customer are aware of your product. You need not to spend much amount of money in promotion, but you need to take care of the product quality. So who are the competitor, whatever innovation they have done, you need to modify your product to remain in the market. Again, in the growth saturation stage, you need to give the facelift to your product so that it will longer time it will remain in the market. Otherwise, it will come to the declining stage. Here you may reduce the price, or some sales promotion you can do, buy one get one, or 10% reduction, or sometimes some kind of thing you need to do to revive the market, or you need to modify the product. Again, if it is going to the declining stage, what is the strategy you need to do? You must have seen that many products they go to the decline stage. Again, like from Caesar brand, you need to take not only Caesar, there are other players also like Kellogg's. Kellogg's company was facing lot of competition in Indian market. So later on, it changed the product into wheat cornflake. So to satisfy the Indian market, wheat cornflake, which was the big demand in the market. So it has changed its product, modified its product. Similarly, women's to keep fit, they have launched a women product, cornflake. So similarly, you need to change your modified your product to remain in the market. Otherwise, it will be very tough time to survive in the market in the life cycle. It has been seen that more than 70% products are failing in the market. This is all about your product life cycle, or in short, we call it PLC. Any doubt in this one? Shall we proceed further?
Yes, sir. It's very clear.
Okay. Now you can see the different stages of PLC and its characteristic. Now, different stages, you can see that introduction stage, growth stage, maturity stage, decline stage. What are the sales characteristics, sales strategy? Introductory stage, sales will be low because people are not much aware of the product or the status of the product or quality of the product. When a new product is launched, so people will not be readily accepting that kind of product until unless they get some idea about the product. So in this case, sales will be low. Growth, fast growth will be there in growth stage. What will be there? Sales will be growing fast because in growth stage, people are much aware of your product. They know what is the quality of the product, what is the specialty of the product, and availability of the product. All this they know. So sales will be growing in this stage, growth stage. And again, when it comes to the maturity stage, in this case, sales will be slow because people need some kind of changes in that one. They are fed up with the similar kind of product. So they need some kind of specialty or some kind of innovation in your product. If you are innovative, you can make your product, make a new product, or develop some kind of addition to that one. Then your product will be again accepting in the market. Otherwise, it will be slow sales. Then decline stage, sales will be declining because here it has gone to already the down stage. People are accepting other products, similar kind of product. They are in the market and they are in the growth stage. So you need to do something like Caesar brand. Twice it has gone to decline stage. Again, it has revived in the market. Similarly, you need to take care of the product and see your competitors, they are in which stage, and you need to develop some kind of strategy so that your product will be again remain in the market. Otherwise, you have to kill the product. Otherwise, there is no way you will be going in loss. So in that case, innovation required. You know that P&G company, Procter & Gamble, they have more than 10,000 scientists associated with the product. And they were connected with the many of the institutions to conduct the survey, research, and all these things to know about the product and modification of the product so that they can create the innovative product. So like this, all the product manufacturers, they need to take care of the product. These are the stages they have to face. Next is profit. What will be the status of the profit? In introduction stage, profit is negligible because you need to spend lot of money in promotion, production, then distribution, innovation. All these things you need to spend lot of capital in that one. In that case, profit may be negligible in introductory stage, and moreover, sales will be very low, so that profit will not be sufficient. So it is negligible, and sometimes it go to negative profit also. You need not to be worried for that one. You have to accept that one, and you need to take forward your product. And when it reaches to the growth position, sales profit will be peak level, because people are all aware of your product. They have accepted very nicely, and it has gone to reach to the growth stage. People are demanding your product, so profit will be at the peak level. Next is maturity stage. What will do the status of profit in maturity stage? It will be declining. Your profit will be declining, because as the sales becomes slow, so demand will be lesser, so it will be in declining stage. So as well as your profit will also be declining. Here you need to do some strategy to again increase your profit. The decline stage, the profit will be low, because here already it is at the stage of get killed, because no one is liking your product now. It is an old product. It is a old technology is being used. Now latest technology has come. You need to revive your product. So profit will be lower. Then case inflow. In case of introduction stage, case inflow will be negative, because as your profit is very less, you are investing a lot of money, so case inflow will be negative. And in growth stage, case inflow will be higher. And similarly, maturity stage, it will be moderate, and declining stage, it will be low. And similar, other one is competitors. So introductory stage, as your product is innovative product, some kind of differentiation is there. So competitors will be few competitors. But in the growing stage, there will be lot of competitors, because similar kind of technology, many of the companies, they have launched product. So many competitors will be there. Competitors will be growing. And maturity stage, many of the competitors, because already they are in growth stage, and many competitors are there. They are struggling in the market, so competitors will be more. And here decline stage, why competitor will decline? Because many of the product will not be survived in the market, because it is in decline stage. They were not able to give the life to the product once again. They must have killed the product, so they must have left the business. So in this case, competitor will be declining. Somebody will be selling the product to means company to someone else. Someone will be merging with some other company. So competitor will be declining. So next one is customers. So introductory stage, innovative customers will be there. Who will buy your product? A new product is launched in the market. Who will be accepting you? Because they do not know, aware of the function of the product or the quality of the product. It is a new product. It's a trial basis. So only innovative people, they will be buying the product. Suppose a sports bike is launched. New company has launched a sport bike. Who will be buying? Very low people, innovative people who are, they will be buying this kind of. This we will discuss in next days. Adoption procedure. How the new product will be adopted by the customer, we'll discuss. So innovative people will be buying your, customer will be innovative people. Then in growth stage, mass market, because market has accepted your product, so mass market will be there as your customer. Then maturity stage, same mass market, but they need some changes of your product. Until unless you change, it will go to laggards. Decline stage, laggards. Laggards in the sense, those who are very reluctant to buy this product. So those are called as laggard people. So reluctant to buy the product, such kind of product, because it has not got any innovation in the product. It has become very old. So people will not be liking your product. These are the different stages and its characteristic, and what are the strategy you need to adopt in a product life cycle. Now next one is new product development. What is a new product? New product, it can come through acquisition or new product development. Acquisition in the sense buying whole company or patent or license someone else's product. You can launch the product. Suppose if foreign product is launched in a foreign market, Indian market is not there, you can take license from them or patent from them, you can manufacture the product here in India. So by acquisition, you can launch a new product. Next, what are the different stages in new product development? So the first stage is, this is also very important question most of the time, examination point of view, it comes in the, what are the different stages in product development? First is idea generation. You need to generate the idea. For new product development, you need to have idea. Where from idea will come? Idea will come from the different sources, like from your customer. Customer are fed up with the same old kind of product. They need some kind of innovation in that one. You can get the idea from the customer. You can get the idea from the your sales team. They know that what customer needs. So from them you can get the idea. You can get idea from the research and development team. Research and development team, they will give the new idea. Similarly, you can get idea from the competitors. Competitor has launched some innovative product. You can get the idea and can design your product. You can get the idea from the different scientific magazines. From that, you can like 3D pictures. Nowadays, it has become very important in marketing, like artificial intelligence. All this has become very important in marketing, digital marketing. All this new kind of idea you need to develop. Once idea is generated, idea screening. You need to screen the idea. You have collected various ideas. Now you have to take a single idea. You have to screen the idea, which will be suitable for you. Okay. For example, you want to launch some business. So you will get the idea from the market, that what are the demand in the market, what business I can do. So different, you can get many kind of idea. Out of that, you have to filter which you are going to follow or which idea will be suitable for you. Once the idea is screened, then concept development testing. Concept, you need to develop the concept, how the product will be, what will be its quality, what will be its price, what will be the function, all this, how to distribute, how to commercialize the product, how to communicate with the customer, all these things you have to, concept you need to develop. Then next is concept testing. Here two things are there, market testing and concept testing. You should not be confused with market testing with concept testing. Concept testing is early stage and market testing is the last stage. So concept, you need to test your concept. What is the concept of your product, whether it will be feasible or not. Once the concept is tested, you are okay with that one, then you need to do business or market analysis. You have to analyze the market. Who will be my customer? What will be the target group? What is the geographical location? How to distribute through dealership or through independent showroom or through online. Or you need to see that, analyze the market. Who are the competitor? What kind of innovation I have? What will the price for my product? Whether customer will buy the product or not. All this analysis you need to do. Then after that, you go for actual product development. This is the real kind of product development you need to do. It is not mass product development, actual product development to test the market. You have to develop the product. Like for example, you can say you want to purchase an apartment. So builder has not made the apartment yet, but he has made the blueprint. Now there is a through on internet, you can walk through system, walk through mechanism. You can they will show you that how the apartment will be, how the door will be, how the bedroom. You can walk through the if you are entering the how door will be open, how the bathroom will be, everything you can virtually you can see. So such kind of development has to be made, and then you need to make the actual product. When the product is ready, you will go for market test. You'll go for, how will you go for market test? You launch the product in the major cities or major places wherever you feel that my target customer will be there. In that, if you find all right, the customers are accepting, then you may go for further stage. Otherwise, you need to identify what is the problem in your product. For example, you must have seen that many of the journals or sports magazine, what they will do in that small sachet of sports drink powder, the sachet will be attached to that sports journal. So to test the market, how people will be liking sample, whether they like it or not, they will give their feedback. And once then you need to launch the product in the some popular market or some zone, so that you need to see that if it is accepted by the market, then you go for commercialization, full plane mass production will go. These are the different stages of new product development, and there are many other things are there in between, but broadly these are the steps you need to understand. And in case of examination point of view also, you need to write this all these 6-7 steps in question may come like, what do you mean by new product? What are the different stage of new product development? So you need to write and explain, and if possible, give small example in day-to-day life. It will be suffice. So this is about the new product development. So what are the reason for the failure of new product? Why new product fails in market? As I told you, more than 70% failed in market. Why? What is the reason? Very few product survive in the market. You must have seen the daily, how many every month, how many brands of cell phones they are launching, how many types of cell phone they are launching. Smart watches, you can see now the flood of smart watches, which was available in 10,000, now you can get it in 4,000 itself. So all this company boards, this, that, all this you can know it. So all smart watches company you must have seen, and you must have analyzed the why they are launching so many kinds of varieties of smart watches or cell phones, because based on the customer's demand, customer's liking, and you never know that which one will be accepted in the market, which will be selling in the market. Again, to balance the product line, they launch so much kind of so many varieties of product. So what are the reason? What are the different reasons? Overestimation of market size. You have not estimated your market. Like where segmentation, STP, I explained you demographic segmentation. What is the demography? You need to know what is the demography of the area where you are making your business. So if you overestimate the market size, so in that case, the product may be shortage of product. You may not be able to supply the product, or surplus product will be there. In case of surplus product, what you will be doing? You will be selling the product. Remember what I discussed about the difference between marketing and selling. Marketing, identify the need of the customer and make the product. But in case of selling, you have surplus product and somehow sell the product in the market. So it will be this kind of situation, overestimation of market size. Next is poor design. If your design is poor, if you are not properly designing your product, then there will be a failure. You must have seen that many of the car making companies, including Toyota, Tata Car, Toyota, and many other companies, even Suzuki also, they have faced so many kind of fault in between. Some car is having fluid problem, some car is having overheating problem, and Tata Nano car, once it was coming out of the showroom, it caught fire. So all this faulty thing, if your design is poor, then it will fail in market. No more they will be liking the product. You must have seen that Tata Nano car. So it was a big demand in the market. Again, Tata Nano car, how the idea generation, idea came to the market. Once Ratan Tata was traveling in some North Indian town, he saw that in one scooter, 4 or 5 full family were sitting in a motorcycle or scooter, 5 people. He thought that there is no safety in this one. If I can design a car within that range, the people will be liking. So a bike will be, or the scooter will be around 50,000-60,000. Another 40,000 if they spend, they can get a car. So idea came to his mind. he developed a car in 1 lakh rupees. But it was a big demand. But again, it became a news that it's a fire catching car. So again, declining of the acceptance of the car. So like this, if there is a faulty design, it will be a problem for the product. So incorrect positioning. Next is positioning of the product incorrectly. Again, STP, why I was talking important, segmentation, targeting, positioning. If you segment the market, target the market, and positioning is faulty, you have not properly positioned. For example, if you are launching a scooter, if it is not clearly, if you have not clearly positioned the scooter, that whether it is made for male or female, like Scooty, you must be remembering that advertisement like Hi Scooty Girl. That means they are launching the product, positioning the product at a Scooty is a product for the girl. Similarly, if you are positioning your positioning of the product is very clear, then people will be. Otherwise, if it is a demand, whether it's a male product or female product, or for both, so there will be confusion. There will be a confusion in the mind of the customer. So, incorrect positioning. Correctly, you have to position the product in the mind of the customer. Then wrong timing. If timing is wrong time you have launched the product, then nobody will accept your product. If product is launched at a proper time, you need to identify which time, when to launch your product. Like pandemic period, people have launched the product like what is that? Oximeter. Because there was a need of the time. Many of the companies they launched the product oximeter because customers they need it. So if the time is wrong time, then product may fail in the market. Next is price is too high. If the product price is too high, customers are not ready to pay, then in that case also product will fail. But yes, if price high, if it is justified, your product is very innovative, then people will be ready to buy your product. Otherwise, it will fail in market. Next is ineffective promotion. There is no proper promotion, no proper information to the customer. Customer are not aware of your product, or it is not effectively communicated to them. Because communication is also a skill that if you wrongly communicate something, it will fail in market. For example, you take any product, ineffective promotion. Promotion in the sense, if you promote the product, communicate something wrong, then it will give the wrong impact in the mind of the customer. You remember M.F. Hussain, the famous painter? He has painted some Indian goddess in his skill, some art he has painted. But his motto may not be to insult the people who are worshipping those goddesses. But the communication, it has been communicated in such a way that he has insulted. And unfortunately, he has to leave the country. He died in some other country. So communication, if it is wrong or miscommunication is there, similar product will be also failing in the market. So communication must be proper. Like one more example I will give you. In South Africa, one of the what is that product name? They launched a car. Ford company launched a car in South Africa. South Africa, North Africa, somewhere where he launched the car, but it was not accepted by them because they kept the name, brand name as Ford Pinto. Pinto is the in South African language something this offensive. So they didn't buy the car because that name itself gives the different perception in the mind of the customer. One more car was launched in a country in North America somewhere, Nova. Nova, by thinking that's novelty, they launched the car. But in their language, it means that don't move. The car which is not moving, the name suggested don't move, then how the people will buy such kind of car? So it failed in market. So communication should be your even brand name, your like for example a brand name, Fair and Lovely. So what impression it will make fair and lovely? So people will be thinking that it creates some psychological impact in the name of the customer. Even logo, it gives the different kind of perception in the mind of the customer. If logo is innovative or very clear idea is there, then like Nokia, you can see the two hands joined together, connecting people together. What they say? We connect the people together. So how clear the message is. So these are the things you need to take care in the communication also. Next, management influence. If management influence is improper, then in that case also product may fail. High development cost. Initially, you have development is too high. You want to get some profit out of that also. So in that case, product cost will be higher. So people may not be accepting your product. Next is competition. So there are a lot of competition in the market. You need to compare the product, your product with the others, and what kind of innovation, what kind of differentiation you have. So if you are not able to meet those type of competition or those kind of product, then your product may fail in the market. So this is all about the product development. Next one is innovation of diffusion of new product adoption. Shall we proceed with this one, or will stop it here?
Sir, we can proceed.
Hello?
Continue, sir.
Continue. Okay. So next is, I'll take some 5 minutes and interview. Next is innovation diffusion and new product diffusion. So innovation and diffusion, what is that? When you launch a new product in the market, what will be the adoption procedure of the customer? This theory, people different types of risk-taking ability and attitude towards the change. What is that? As I told you, when the product is launched in the market first time, it is in pioneering stage. Customer are not aware of your product. So who will buy your product? Only innovative people. I told you earlier that innovative people will be buying your product first, because they are ready to take risk, and their attitude is like risk-taking attitude. So those kind of people, they will be taking your product. This affects their willingness to try and adopt a new product. So this attitude, risk-taking attitude, it will be affecting their willingness and to try a new product. Based on these two parameters, the time they take to try a new product, customer can be grouped as, based on this timing, it can be grouped as 5 groups, like innovators, early adopters, early majority, late majority, laggards. As I discussed in product life cycle, innovator and laggards, we'll discuss about other 3. Who are the innovators? So you can see pictures here, innovation of diffusion, the bell-shaped picture, that is like a bell. So who are the innovators? Only 2.5% people are innovators. When you launch a new product, only very few people, they will be accepting the new product, so taking risk. For example, iPad is launched. How many people, sir, will be ready to accept? Very few people. So 2.5% people are risk-taker people, innovative people, they will be accepting the new product. Then next is early adopters. Another 13.5 people, they will follow this 2.5 people, innovators. They will buy the product. They will be ready to, once they are aware of the product, they will be ready to buy the product. So these are the innovative people. Just a second. Next is early majority. Next, once the early adopter, they take buy the product, the early majority, they will be try to confirm the product, what is the quality, how it works, what is the all these things, they will get awareness from this early adopters, and they will be ready to adopt the product. Those are 34% people will be called as early majority. Then similarly, late majority. Many of the people, they will be, after trying, struggling, everything, they will be accepting the product because they know that the early majority people, they have already accepted the product, and from them they will try to understand the quality and about the product, then price, everything they will come to know. Then they will be accepting the product. And last 16% people are called as laggard people. So they will be very reluctant to accept the product. So 16 people, such kind of people are there in the market. This is the innovation diffusion or new product adoption procedure for a new product. For any new product, people will be like this adopting the product. So that is called as new product adoption or innovation diffusion. Is it clear?
Yeah, yes, sir.
Yes, sir.
So any doubt or anything, 1 or 2
No,
minutes
sir.
you can ask me. Otherwise, we'll wind up the class. And next class we'll be discussing about the pricing. The unit 3 pricing, ACSL, right?
Okay, sir.
Yeah, yes, sir.
Anything you want to know?
Sir, when will upload the PPT in website, sir?
PPT, once class is over, immediately I'll upload the PPT.
Okay, sir. Yesterday week it's not uploaded.
Sorry?
Yesterday week it's not uploaded.
No, it is once the complete class is over, complete PPT is there. Something they are adding, they are deleting. So at the end we will upload
So
it.
any idea when the exam will be
You can find
starting,
it in
sir?
our exam will be in the month of January.
Okay.
Yeah.
January, I think second week or like.
That is final. It is not finalized. Once it is finalized, we'll upload in our.
Okay, not December in, right?
Not in December.
Okay, so that was good feedback. Thank you, sir. Thank you.
Call me after 5 minutes, please.
Thank you, sir.
Yeah. Anything else?
No, sir.
Sir,
Right, thank you.
just a quick one, sir. So along with the PPTs, would you also be uploading the videos, the recording videos?
Yeah, that will be also recording will also be uploaded.
Okay, sir. Thank you very much.
Thank you, sir.
Thank you. Thank you. Have a nice day.
Thank you.
Thank you,
Thanks,
sir.
sir.
Thank you, sir.
Hello, Satish, am I audible?
Yes, madam, very much audible.
Yes, madam.
Just I'm trying to switch on my camera. Just hold on. I think they're muted. Satish, are you hearing me?
Yes, ma'am.
Yes, madam.
Now you are hearing me. I would like to switch on the camera. Just hold on. I'm trying to open my PPT. Just hold on. I need permission from the operator. Satish, in the camera, this presentation enable pannu Satish. College meeting la. ஆமா நான் ஆன் பண்ணிட்டேன். ஆமா Okay, now it is enabled. Just I'll open my PPT. Hold on, please. Are you able to see the PPT?
Yes, ma'am.
Yes, ma'am.
Okay. So shall we start the class?
Yes, ma'am.
Yes, ma'am. Yes.
Okay. Let me introduce myself. I am Dr.Punitha. I am faculty of Directorate of Distance Education, and I take care of the Human Resource Department here. And now, as I just now told, I'm going to take the subject Human Resource Management. And as this is about people, I would like this class to be conversational because see, I am not looking at you and you are not looking at me, and already I am staring at the screen. So I think as this is the class about people, let us at least hear our voices, vice versa. So if you ask or you join the conversation, you give your opinion, the classes will be lively, and I will also get some motivation to say more about the expertise what I have. Is it okay?
Sure, ma'am. Sure.
Yeah. So to make this effective, the conversational classes, it is better to restrain yourself. If somebody else is speaking, we will get chance each other. So let us not overlap the voices. Is it okay?
Okay, ma'am.
Okay.
Right. Okay, nice. So let us start with the subject.
You are in second semester now, right? So you know about management. You have studied in the first subject called concepts of business in the first paper. It says a lot about what is a business, what is an organization, how it is run, what are all the resources needed to run the organization, so on. So all these things you have learned. Hope so, right? Have you cleared the first paper?
Yes, I've cleared all the first semester papers.
Anybody having any doubts in the basic concept of an organization or business? Okay, so let's take it as a no. Nobody is having a doubt. So I assume that all of you know about organizations. What is business, right? So hopefully you would have heard about the resources that runs the organization. What are the necessary, essential resources that is we need to run any organization? Anybody can say.
The resources.
Human resources.
Okay, human resources.
Resources, capital resources, machine resources, management resources.
Very good. So easy to remember it easy. We say it as 4 M's. You know, you need money, material, machines, and men.
Manpower.
Okay, so easily you can remember these 4 M's. Out of these 4 M's, the 3 M's are under your control. Like, you know, money. You can invest, you can earn, you can spend. Machines, you can buy it, you can run it anytime you need, switch on and off. You can run 24 hours, 2 shifts, 3 shifts, it's up to you. The same way, materials, you can buy them, dump them, convert them, produce them, all you can do. But the 4th M, that is men, it is a critical one in any organization, you know, because it is not under our control in the sense we control the other things. Do you accept this? Do you agree with me?
Yes, ma'am.
Anybody disagrees this?
No, ma'am.
Yes,
No.
because you think yourself in that place. You are a human resource in any organization, right? Do we like to be controlled by our owners like a machine or materials? A big no. We never like that, right? Why? What is the difference between these? We have thinking skills, we have characteristics, we have a set of behavior. We are people. We cannot be treated like materials. Am I right? So, this human resource becomes the most important M in any organization because that is a challenge any organization is going to face. You can buy a machine. See, for example, I go through a catalog of a German-made machine. I like that it is going to suit my organization. So what I do, I order 10 numbers of that machine. Okay? Identical, similar. I buy 10 machines. I can run all the machines with one person, one catalog, one training. That is enough. Right? But can I get 10 people who are unique, similar, and identical? Impossible. Maybe the job is right, okay? 10 missions, I need 10 mission operators. I have to hire 10 people to operate these 10 missions. Okay? Can I get all the 10 people with the same characteristic? Because I can get to the same qualification. You know, I can go to a college or I can go to an ITI where a set of students are coming out who knows how to operate this machine. So qualification is equal. I say that whoever gets more than 80%, I'll take. No problem in that. All the 10 people are equally qualified. Maybe same age because I'm taking from placement. Everything is okay. But do I get the same treatment or same output or the same kind of working productivity from these 10? Is it possible?
No, not possible.
Yes. Now I think you know, what do you say, the uniqueness of this human resource, right? This is where our management comes in. So if you want to be a human resource manager, or if you own an organization and you want to control or manage, direct, administer these human resources, then we have to know them, understand them, and empathize them. These are the three mantras you should remember if you are going to be a human resource manager or you are going to own a company with a lot of people working in it, right? So this skilled or unskilled or organized or unorganized, whatever it is, the supply of this human resource has to do little with our recruitment, right? So let us see what two great people think about this human resource. I have given you two quotations to think upon. We have to treat the employees with respect and dignity. This is what Mr. Narayana Murthy says. Why, you know, as I told you, remember these 10 machines and 10 machine operators. If you are not treating them with respect, do you think that machine man will treat his machine with respect? No. What you give is cascading, right? See, for example, I am shouting at my machine man that he has taken a long break. He went to tea and he took some 10 minutes for that. So he comes back with a vengeance on me. Okay. So he comes to the mission. And unfortunately, the mission is making some noise. What he will do? He will give a kick to the mission. Am I right?
Yes, correct. Madam, this slides you're forwarding to next slides or in the first slide only? We are not seeing the slides.
Oh, I have changed to the second slide. Are you not able to see the second slide?
No, ma'am.
No, ma'am. Still in the first slide?
Yes,
Yeah,
ma'am.
Yes, ma'am.
Oh, okay. Thank you for saying. Just hold on. Give me 2 minutes. I'll see what is wrong. Okay.
Okay, also show it in the slide, madam.
Are you able to see now?
No, madam.
But you are able to see the first one, right?
Yeah, first slide only show.
Can you see now?
No, ma'am.
Yes, move now. Second
Now,
stage. It came the
Now
second.
it's open, right? Are you able
Madam,
to see the second screen?
yeah, show in slideshow, madam.
There is a mode
Yeah,
called
I'm going in
slideshow mode.
slideshow.
Yeah. Okay, thank you.
Are you able to see now?
It is still in the normal view mode, not in the slideshow, but still
But
you
I
can
have
proceed,
changed
ma'am.
it. Are you able to see?
No, ma'am.
No, ma'am, you can
Still in the
proceed.
normal view. You can proceed,
Everything
madam. No
is
problem.
right. I don't know what is wrong. Let me check once. Are you able to see now? The second
madam.
screen?
No, ma'am.
Screen is yet to come. Screen is yet to come.
No?
No, screen not visible, madam.
No, ma'am.
Wait, let me see again. Are you able to see?
Yes, ma'am.
Yes, ma'am.
Second screen, are you able to see?
Yes,
Yes.
ma'am.
Okay, right. That too in this not in the slide mode, right? Presentation mode, is it?
It is normal view, not on the slideshow. It is normal mode. No problem, madam. You can proceed.
Okay. Okay. If it is not moving, please once again tell me, okay? Right. So where were we? Right, that is kicking the mission, right? So the respect has to be there for any people, otherwise what happens? They feel, unlike the machine may not feel that he is kicking and it is not going to reciprocate it to him, but the people do that, right? So you have to have the power of human mind in your organization to bring in innovation, to make things happen in the organization. How that happens? Only if you empower them with respect. Only the people who are respected or feel that you are carrying them, they give back to the organization. This is what is. And what about the other quotation? Why I have given is, you can see that. See, now we are not in the era of our forefathers, like what our grandfather and father were working. That human resource era, that scenario was totally different from what we are now. Because now we are in the age of AI. The robot hands do a lot of things, like starting from surgery, right? Many of you would have seen the doctors use robotic hands to do very nuanced surgery where they are not able to see or reach to some of the nerves. Okay, like that. Then think about manufacturing, like car manufacturing. Many of the assembly line are now replaced by robotic hands. Many things are done by the AI now, like carving, even the carpenter work. We are getting replaced everywhere. So what happens? We are getting replaced, and the meaning is human resource, the necessity of the human resource is getting lower and lower every day. So how we are going to tackle this or cope up with this? What is left for us humans, human resource? Only those jobs where we can apply our skill, our intelligence, or that empathy, caring, creativity. These are the areas only left out for human where still thinking is necessary. So what we have to do in this one? We have to make ourselves employable only for these kind of jobs where the machines cannot replace us. So we are in this era. So with this introduction, let us get into the subject. What is human resource management? It is a people dimension, actually, like how you see the people, how you want the people to work for you. How we do that? We have to acquire them. If you acquire them with a set of skills, that is called recruitment. But is it enough? No. If you want to keep them working, if you want the productivity to grow, you have to develop their skills. Maybe you might be wondering why I have to do that as an owner, but that is the truth. If you want the people to be more productive, it is the responsibility of the organization also to keep them motivated, to keep their fire going so that they will perform better. So other side, you can say that it is a term which covers all the work areas like work relations and employment relations with the industrial relations. All these three things comes under the scope of HRM. Again, this is about, if you take in the perspective of a business, in the perspective of an organization, HRM is like a policy or a business strategy, how to manage the employees. You need a set of regulations, rules and regulations, how I am going to run this organization filled with people. That is also HRM. And also you can take up the right word is, it is a governance of employees. It is not management, it is a governance. Okay, there is difference between these two. Governing is more broader, more empathetical than just managing or administrating the employees. Okay, let us see how this human resource subject has evolved, how we have come a long way. You can see that first, the human resource is called as slaves. Hard to believe. Think about the building.
Moving slides. There is no slides are moving, ma'am. If you're, we are
Still you
still
are
on
not able to
slide
see
two.
the slides?
Second slide on.
Slide two only.
Oh my God, I don't know what is. It is clear. Everything says it is getting shared. I don't know. Okay. I think give me 2 minutes. I'll try to make it another way. Okay.
Now it's moved to the slide 5.
Are you able to see the slide now?
Yes.
Yes, it is.
Yeah, ma'am.
It's moving now.
But not in the presentation mode, right?
It is not in the. It is in the normal view mode, and we are
PPT
seeing
mode.
slide 4.
It is in the
The
PPT mode, right?
PPT mode, and yeah, it is 4. It is
Okay,
going on
then
4.
let it be, no problem. Let us not experiment
Okay.
mode. Let it be in the PPT mode. Okay.
Okay.
I don't think it will be a big problem to you.
No problem.
Okay, right. So now are you able to see the slide?
Yeah, yes.
Slide
Yeah,
number
okay.
4.
Are you able to see the pictures?
Yeah,
Yeah,
ma'am.
one is now
Fourth
fine.
slide.
Very good, right. So the ancient human resource was called as slaves, right? It is not human resource at all. The people, because the regimes were kings were ruling. So what they did, they will just acquire, like exactly the meaning is buying. They'll buy the people. Okay, they are not going to be paid. They will be minimum fed with a minimum amount of food. It's like buying them and keeping them like exactly like the other yams, what we were discussing about, like machine. Men were also treated like machines. They'll be bought from one place to the other and they'll be put onto the work. A very good example for this is building of temples and bigger monuments like the pyramids in Egypt, right? How you think that Herculean task can be done? How it would be done with? Can you imagine that it can be built in this present era with the labor force? It's impossible because we have a lot of rules to avoid that. What happened in those days, human resources were treated as slaves. Okay, but what happens? Slowly we agitated, the slaves agitated slowly. It took thousands of years, hundreds of years. Slowly we were turned into laborers. What is the difference? Laborers are free. They can reside in the place where they want to live. That is the biggest transformation happened from slavery to laborers, right? And what is the other one? They can get remuneration. They can get wages for the work they put in, the effort they put in. What do they do with that wages? What is that wages? A minimum amount that is calculated for 4 people. It is not even amount. I'll tell you how it started first. It is started with the measurement of bread loaf. Okay. Say for example, a man is working. He has a wife and 2 kids. So for these 4 people, how much bread loaf he needs to survive, that is calculated by the capitalist, and the owner will provide him enough money or bread loaf for survival for these 4 people. How they will reside in a house or what about the other expenditures, it is not at all bothered about. This is how the wages were calculated. And slowly after the revolution, industrial revolution was the biggest turning point in this evolution. So after that revolution, what happened? Slowly the people's health care and safety were taken into account. So where do they reside? How they will keep themselves warm in the winter seasons? All these things were taken into account. And slowly it was also considered they have a family and he should be remunerated enough so that he can take care of the family. So this was going on for a long years, like 100 to 200 years. What happens now? We are sitting in AC room or we are sitting in a cozy place, office, and where we are now is a point in the long journey of this evolution of HR, right? So we should be thankful and blessed that we are like, the children of these people who have fought for us, that for the welfare of us. So we are able to be employees, called as employees, right? Shall we move on to the next slide? Okay. So what I have done, I have given you a timeline period of how this has come up. Like, see, welfare officer was the human resource manager called in 1890s. And after that, he was called as labor manager. And from 1940s, the entire subject was turned into personnel management. Personnel management is how you manage the people. And slowly it was termed in 80s as human resource management because this was considered as a resource. It has to be replenished, it has to be managed and well paid and maintained. And now we are in 2000 era, we are in 2K. So what is it called? Human capital. That is the biggest, or what do you say, the best thing that can happen to this journey of human resource. Now we are called as human capital. What is the meaning of capital? It is asset, right? So now the human resource is treated as asset of an organization like any other asset. So every person in the organization is respected for his ability, skill or competency or whatever he may be having. They are called as business partners now, like assets, right? So this is the evolution of HR. We come to the next part of the history of HR. How this HR movement happened slowly. That is how the evolution is okay, but how it is changed. What are the things that has made it possible? In 1920s, Hawthorne studies was conducted by Elton Mayo. This is one very big turning point in HR movement. After this, people realized that the people working in groups or in crowd in one place, like laborers working in a factory, they too have feelings. They too have a set of behavior. That was understood after these studies. Otherwise, they were treated like, domestic stock, like livestock, like goats, like what do you say, sheep, that they will all behave together like sheep. But after the studies, they were treated like people. They have some feelings. And 1930s, industrial psychology was developed as a separate discipline. Why this was important? Previous to that, human psychology was there for a long time. People, how they behave. But in 1930s, after this study, it was understood that the psychology of people in a house or in society is different from the psychology of people in a industry, in a working place. How to make you understand this? Imagine like this. You are head of your house, right? How you behave in your head as a leader? You will be giving orders to your kids, or you will be making or giving statements to your wife to do something, or your wife may be the head of the home. She may be giving orders. The same person comes to the factory. He is a junior worker, right? Can he exhibit the same authoritative tone inside the factory?
No.
Is it possible?
No, it's not possible.
Yes or no?
No.
See, better answer, because I'll ask questions so that it is like a proof to me that you are not sleeping. Somebody is listening. Otherwise, think about someone who is talking to herself with no one to listen. How pathetic then I will be. Okay? So give me some consideration and say yes or no. Okay? Right.
Sure.
So you say that the person behaves different in front of his supervisor or boss. So can we say that he is two different person? No, he is the same person. But his behavioral psychology is different because he comes to the industry. His set of role, his set of rules and regulations, his set of attributes and traits are totally different because of the external factors that is confirming his behavior in the place of work. Right? So this was understood in 1930s. This is a very important turning point where people started understanding that people have a separate psychology in the workplace. After that, what happens in 1950s? A collective bargaining concept has emerged in this area, and this is a real game changer. What happens if a person meets with an accident before that, say 1930s? What the people will do, I'll tell you. Not in 1930, I worked in an industry recently, that is some 10 years ago. It's a factory and a QC department. What they did, they were holding the testing acid in a 7-Up bottle. Why the girls have changed that, it is easy to use. We don't know that. They were given with a particular jar, container to hold the acid. But that was having a bigger mouth bottle, which they found it very, very difficult to use. So for easy of using, one of the girl or many of them, they had the practice. They pour that acid into a 7-Up bottle, which is easy to hold and use, half-liter 7-Up bottle. One girl who entered into the QC area from the production area, unknowingly, she is newly joined. She unknowingly took it as a water and drank a sip. Okay. This has become a very big incident. what the management wanted to do when she was admitted in the hospital, to say that totally it was her mistake and there is nothing to do with the factory, right? If this can happen 10 years ago, think what will be the situation in 1920s and 30s. There will be no consideration for the laborers or accidents for whatever happening in the area of production. So how this changed? The concept of collective bargaining. Now we call it as unions. If I say trade unions, you will easily understand that. What is collective bargaining? If a single person go and bargain, shout with the management, see, I have got an accident, you have to pay me. Nobody will listen. But think if that accident stimulates some hundreds of workers in a place and all of them go on bargain, collective bargaining. This person has met with an accident, so you have to pay for the hospitalization and treatment. What will be the effect? Can you imagine? Which one will be effective?
Collective bargaining, since
Yes,
people
it's
are
an easy question, just to ask it to check, right? So collective bargaining becomes an important concept in 1950s, which has emerged as trade unions, and trade unions have become a successful concept which has turned over the tables of capitalism and laborers. In 1980s, what happens? Because of the globalization, slowly after 30 years, you can see that because of globalization, the migration of the labor force was imminent. It was phenomenal in 1980s because of the opening of gates. So a lot of migration happened, and this opened the doors for diversity in the labor force. Okay, so what happens? The so-called culture or ethnicity of the particular place, of that particular topography, has started changing slowly. So when new people come with new culture and new thinking, slowly there are new concepts in the HR. In 1990, movement, and in 2000s, you can see that HR is seeing its peak. Like now we are saying that HR is getting strategized, how to retain the human resource. Human resource is treated as asset. Every person is valued. Every person's input is valued. So you can say that if you see the long journey, you are in the, cloud 9. You are in the best place now. Okay, right. So these are to understand how the HR has traveled so far. To make you understand about how this has evolved, or what are the things that intrigued the mind of the people who are controlling these people. I'll tell you only about his Hawthorne studies. Okay, this will give you a better idea how this works. See the illumination nearby. Are you able to see a lot? Yes? Are you able to see the slide?
Yeah, yes. Yes, ma'am.
Can you see the light changing?
Yes.
Yes.
Yeah. I would like to know any one of you saying how do you feel by looking at that? What is your
Changing
feeling
the
by
color.
looking at the colors of changing colors? Look for 10 seconds and tell me which color is soothing to you, or which color you like, or which is pleasant. Whatever feeling you may be feeling, you just tell me that. Anyone?
Green looks better to bring.
Okay. How green looks better. Very good. How do you feel when colors are changing after 10 seconds? Irritating?
It's attracting.
Yes?
It's attracting.
Attractive. Okay. After some time you are looking at that, after say, imagine after 10 minutes, how will you feel?
Disturbing.
Sometimes
It will
it's
disturb.
irritating.
Irritating. Yes? யாரது படிப்பிக்கின்றது? Listen here, okay? Right. So the point is, this is called illumination experiments. Okay, it's okay. So this is called as illumination experiments, it was called as, right? So what the Hawthorne studies basically did, change the lighting of the assembly room. See, a lot of people are sitting there. They just changed the lighting. They increased the brightness or decreased it. or change the color of the light inside the room. How they did it for long years. They recorded all the productivity results, and this has given a lot of understanding on people relation, right? This is the, what do you say, which is unexpected result, you can say that. Okay, this made the people understand that it is more about whom they are working with than what the light is in the room. I'll tell you one by one. This is, the first one is called as illumination and productivity experiment. What they wanted to experiment is how the illumination affects the productivity. And what was the result? There is no relationship. Whatever be that, it is only about a time to get settled in. First, see, the moment you change the brightness, you will feel attracted or irritated or something. But after a few days or a few months, you get used to that. Your mind get used to that. And once again, you get stagnated to that line, and productivity has nothing to do with that, right? Say, for example, if you in Norway for continuous 6 months, there will be sunlight, and again 6 months it will be dark. I feel pathetic for them, because the interesting part of any life is a change of day and night. You are anticipating, okay, there is a change by today evening 6 o'clock, the sun will set, you will get dark night, you can sleep. Again, if you sleep after some, say, for example, 2 o'clock, 3 o'clock, you will be anticipating, if you wake up by that time, what you will be anticipating? Okay, another 3 hours, the sun will come up, a new day begins. Are you able to understand my point? So the change keeps you going. The change makes you feel thrilled about the next thing that is coming. So that is how the change in the illumination has created a small hike in the productivity. But after that, once again, it gets stagnated. This was found out in the experiment. The second experiment is the relay assembly test room. What they did, here they made 2 different groups of ladies, okay, and give them a little bit of freedom on how they want to work, where they want to sit, whom they want to sit with, whom they want to talk with, friends with, what is the break period they want, when they want. So there were set of rules, but made by those people. And what was the result? There were a greater effect on the productivity. How? The working condition is lesser, or it is noted lesser when you are with a group of people you like the most. Are you able to get my point? You are able to adjust all the other external factors when you are given with freedom and with people you can easily socialize with. So the second experiment was very fruitful when compared to the first one, because after this relay assembly test room experiment, the capitalists or the owners started to understand that it is what do you say, beneficial for the company if they allow socializing in the company. Because why, you may feel this is a new thing, but during those period you cannot talk with the person in a company. You cannot marry a person in the same company. One of them will be fired, or sometimes 2 of them will be fired, right? So what do you say, like socializing threatened the organizational owners, because they thought if the laborers talk with each other, they will form a union and throw you out. So in those conditions, this particular experiment has proved to be very fruitful, right? Then the third one, this is interviewing program. This was done direct questioning. Okay, they were talked a lot of interviews. Like, you may not believe how many interviews they conducted, more than 20,000 interviews. Okay, so what was the result of this experiment? Why you have to be interviewed? Do you think that 20,000 opinions of the employees is going to give you some statistical answer? Is it possible? No, never. Okay, you will be mad if you are able to analyze all those things. But the important effect or outcome of this interviewing program is people, those who were interviewed, that is the employees, those who were interviewed, felt very happy, and they felt after the interview that they belong to the company, and because of this affiliation, the productivity went up. Are you able to understand my point? Anybody?
Yes, ma'am.
Yes, okay. See, at any point, at any given point, if any one of you not able to understand or you want me to repeat or want to disagree with me, kindly open up and talk, okay? Because the purpose of the class is that I would like to reach you. It is not, the purpose of the class is not that I have to finish my slides. Okay, are you able to understand that? So I am ready to repeat rather than going through the slides. Okay, even if it is 10 points you are able to gather from 2 hours class, I'll be happy. Clear?
Yes, ma'am.
Sure.
Yes.
Yeah.
Shall we continue?
Yes, ma'am.
Yes. So what happened as a side effect of this interviewing program, people started feeling that they are valued, even though I am a small laborer in hundreds of laborers in the organization. One person from the owner side came to me, talked to me, asked me how I am feeling. See how happy I will be, right? You don't know what they are going to do with your answers. But as of now, I have someone to listen to me, listen to my grievance. That itself was enough for them, right? They didn't want that grievance to be solved. They didn't want, this is my problem, I want this to be solved. No, they just wanted, this is my problem, hear this out. Clear? This has given a greater understanding of how to manage the people. The second one is, then the management started, that is, if you think that we are on the other side of the laboratory, that we are the managers now, we are studying this course. So we started understanding that the complaints on the organization are not really the complaints on the organization, right? They come from some other deep-rooted disturbances. Like, for example, yeah, as I first told you, a machine operator kicking the machine. Maybe it is a consequence of his fight with his wife in the morning, right? So all the behavior is not directly related to the company or to his workplace. This was understood. Then the third one is, everything is inside and outside of the company are governed by the experience from the company, right? So it is nothing they have to do with what they have felt with the past company or other things. They felt they are governed by whatever I have known. I have acquired the skills from this company. So these three were found out. These are the important things that were found out in the behavioral side of the people through this interviewing experiment. The fourth set of experiment was called observation room. Here, nothing will be done. Just a person will sit and observe each and every bank wiring room. They will sit, they will write what is happening. There will be no interaction with the workers who is working in that particular area. It is like a ghost sitting in the room. They will not at all see. It is like an invisible person, right? So what were the results? When a person was sitting in the corner of the room and looking at you continuously and taking some notes, what will be in your mind? Anyone?
You will feel disturbed and you will be very cautious.
Very good. Discomfort,
I will
disturbed.
feel as a micromanagement.
Yes, very good. That he is like a spy of the management. Very good. Then
Will not be real.
very good. That is the truth. Okay, you will not be true to yourself. You will start faking. You will be like you. I'm very consciously working, but that is not your true self. Okay, if you are doing this for 1 week, what happens? You get irritated. Your behavioral sense is gone, right? So this has given a understanding of how the output has come because someone is monitoring. It created a fear of unemployment, fear of rising the standards, protection of slower workers, and satisfaction on the part of management. These were the output of this observation room. So what is understood? You have to keep a set of norms and not monitor them like a camera, CCTV camera. So when we were studying in the later units, I will explain. Otherwise, I'll tell here itself. So this is still a problem. You can see how this is done, not by an invisible man, but by cameras. You can see that in many of the workplaces now, cameras are installed, right? So there were a universal agitation to this, like this is like monitoring your emails. You know, many of the company emails are monitored. For that matter, not only company emails, in many countries, monitoring the emails is legal. Whatever you think is secret to you is not no more a secret. It is monitored by somebody else. So this is like related to that one when somebody is observed. So what happens when you are doing this is deviated inside the room where you are doing that. So they want to protect the people. So the unions are these kind of collective bargaining roots up from here. And there is a conflict between the management and the workforce. Okay, so all these things were the result of this observation room experiment. So these are the Hawthorne studies results. Okay, so now we come to the next area. We forget about that. The history is over. Okay, the HR history is over. Now we are entering into the present situation where we all are working. How the human resource works. There is a separate department called HR department. Many of you may be having a department in the organizations you are working with. Let us understand how we do this work as a HR department. I have given you a picture. It is the external work. You can see that. It is like a wheel, like tooth wheel, where you will be the center point for all the other departments in the organization, like finance, marketing, operations, technology, sales, and all the other stakeholders. So human resource is like a connecting wheel between all these things, a bond. Why is that? Because in all these departments who are working, apart from machines and other things, people are working, right? Those people are to be recruited by this HR department. So it becomes mandatory that you should understand all these people, right? All these departments. So let us list out inside what are the functions of HR department. If you have to be a bond of all these departments, what are you supposed to do? You have to do a HR planning. Because you are not going to recruit for your own department. You are going to recruit for all the departments in the organization. So a planning becomes must. Okay. How the planning starts and how the planning is done, we will see in the other lessons, in the forthcoming lessons. The next important work a HR department has to do is recruitments and selections. Okay. Why this becomes the crux of the human resource department, recruitment maybe sounds easy. You have to pick a person. But remember, when you recruit or select a person, that might be the end of human resource department's recruitment action. But that is a starting point of that person's career. He is going to work in a department where you are going to place him, right? Just imagine, if you are placing a wrong person in a wrong place and he starts his career there, what will happen? Anyone? What will be the consequence of that? Are you able to understand the question?
Yeah, you will not get the record output. Maybe he is not
Mismanagement.
motivated.
Okay, mismanagement, productivity will be low. Then you are
He
only
may not
thinking
continue.
in organization
He may not.
side. Think on the person side also.
No career growth, madam.
Very good. No career growth. Then still, I would like you to still think further. Put yourself in that place and think, if you
No.
are working in a wrong place for 5 years, then 10
You will
years,
get
what happens?
you will get demotivated, and you
Very good.
will try to go out, or
There
you
will
try
be
to
no
go out
job
for.
satisfaction, and this irritation and dissatisfaction will show in your personal life. Your behavior is affected. You will have a midlife crisis. You want to get out of the company, but now you will not find a right place, right job. All these are vicious circle, and it will affect both the organization and the person. Now you say, is recruitment sounds easy?
No.
So you have to think about a minimum of 10 years of that particular person in the organization. He may not be in the same place, but in the same line cannot be changed, right? So that is how the recruitment and selection has to be perceived of, right? We will be again seeing this in detail in the further forthcoming lessons, okay? Third one, you have selected some person. Now what is your third job? You have to induct him, right? And train him, and you have to orient him. You can see this is like functions of HR. This may sounds like functions of HR, but if you see that in another one perspective, now tell you, you imagine like this. First step, you think about you are selecting one person, right? You go to the steps one by one like that. Human resource planning. You want a mission operator for that particular German mission we have imported some 15 minutes ago. Okay, right. So you are planning. You want to recruit a operator. Recruitment and selection. You are recruiting that person. Say, for example, he is called Balu. Balu is selected. He is inducted. He has to be trained. He has to be oriented. Then what you have to do? You have to think about how he will be remunerated, what his wages will be, what his benefits will be. Okay, everything settled down. Balu is working for 2 years, 1 year. You have to evaluate his performance. You have to check yourself whether you have selected the right person. You are evaluating him. So you are appraising him and managing him. We'll see all these things in details in the forthcoming lesson. Just to listen to the terminologies, that is enough for me now. Okay. Then, now Balu is working for 5 years, 10 years. You see now Balu is trained with that particular mission. It is like his pet. It is like his, what do you say, a dog or goat or what do you say, cow. He knows in and out of the mission. Okay, the mission makes a small noise. You may think there's a big problem. Balu comes in and puts a small stick in a hole and the sound goes off. That much he knows about the mission. What he gathers now, knowledge. So you have to manage the knowledge because Balu may be transferred as a supervisor. Somebody has to be replaced in his position. That position should be filled with Balu's knowledge, which he has acquired from the organization. Knowledge management. Okay, now what happens? Balu is elevated. He has to be put in some other place. So you have to think about the relationship between this department, that department and all. So it all comes down to training and development. Are you able to understand? Is it easy to remember now? If you are to hire a person, all these things you have to do. But not for single person. You will be doing it in batches. Right? So these are the functions of HR department. Once again, you can go through these points because this is a very important slide. This is what we are going to study in this whole subject. Right? Shall we move on?
Yes, ma'am.
Yes, ma'am.
Any queries in this? Till here.
Can you make me clear about stakeholders?
Oh yeah, I'll tell you. Stakeholders here. See, why I have given just stakeholders is it includes a lot of people, like for example, government organizations, right? You have to verify with the, see, for example, you have to recruit a person. So you have to do a background check. So you have to have stakeholders, like you will be sending to the institution or university. You will be meeting with the particular local police station. You will be going to the government offices to verify the Aadhaar card, like this. So stakeholders are all the other people who are related to that particular organization or particular function. Say, for example, even the shareholders or stakeholders of the company, right? Stakeholders meaning is those who are related to that particular point. Clear? Can you go to the next one?
Yeah, okay, thank you.
Yes. Okay. So now, a good manager should have, I have changed the slide. I want you to say what are the qualities you expect from your HR manager and what are the qualities you will exhibit if you are HR manager. One by one, any one of you. First, I would like to know what you want to your HR manager to have qualities.
Keep good relations with
Anyone.
employees.
First, tell your name so that I'll call by name.
Okay,
Anyone.
myself, Vimya KP.
Yeah, okay.
I have to discuss about the quality of an HR manager. He have to keep good relation with employees.
Very good. Anybody else?
Myself,
Kumaran here.
Okay, Bharati. Yes, go on. The girl. Okay, the next one.
Yeah, Kumaran here again. So I would
Okay,
like to say
Kumaran.
the manager to be, yeah, he has to be more good listener. So
Very
since he
good.
is a HR manager, he should
Very
be
good.
listening carefully to the employees.
Very good. Any other thing?
He or she should be empathetic to the employees.
Very good. Right? Empathetic to the employees. Okay. Okay. If you are a HR manager, what are the qualities you will exhibit?
I should have good observation skills.
Very good. You'll be observing them. Good.
How to deal the difficult pupil.
Very good.
Excellent
I should
communication skills and listening skills.
Good.
I should
Should
possess some
interact with
convincing
employees.
power.
Very good. Negotiating skills. That is the one thing I was expecting. Yes, you should be not only listening, you should be able to negotiate, convince them. Very good. Okay, now we go to that slide. Right? So you can check with yourself. Are you able to list out all those things? Let us go one by one. Effective communication. So any communication you can see, as you told, starts with listening, not with talking. Okay. If you are not a good listener, you're not a good conversationalist. You cannot converse with other people. So effective communication is very important for any HR manager. He has to listen to the people, and not only listening, he has to be negotiator also. He should be able to convince. Otherwise, what happens, if you are empathetic, the whining will be endless. I'll tell you, give a small example. If you have a puppy at home, you just go there and say, what do you want? Are you not feeling happy? Just you can see that they will start whining. If you encouraging, they will be whining. It will not be stopped. At one point, you should be able to convince. You should be able to stop that, right? So this is what we call as effective communication. The second one is empathy and ethical practice, right? So why we say ethical practice, it is like a balance between both. See, after all, you are working for the organization, not for the employees you hire. Are you able to understand? I am a part of organization. I am part of the management. Okay. But unfortunately, my place of work is such that I am in HR department. So I have to listen to the other side also. Are you able to understand? So if I
Yes,
have
ma'am.
empathy, I should be ethical too. I cannot always listen to the other side. I should be able to weigh both sides, which is right. How this is done? Only if you have ethical practice, right? Then a third one. This is like a result of that one. You should be able to critically evaluate. If you want to be ethical, you should be very strong in reasoning capacities, actually logical, analytical, and reasoning. All these three is very important quality for a HR manager. You should be able to evaluate critically. How you can evaluate? Again, I'll repeat. You should be able to think logically, analytically, and reasoning power. If anyone is developing these skills, they will easily analyze any situation. And if you are able to analyze the situation, you will be able to take a decision based on your ethical practice, right? So this is another important quality. Then this is a common quality for any manager, business acumen. You should be able to understand what is that particular business and what is the output needed. Then this is a additional quality. Any HR manager should be able to lead and navigate to the followers, because you have, as I told you, keeping money is very easy for a financial manager. He can put it in the bank. It is now online. It's very simple. He can sit at one computer. That is enough. Crores of money he can handle. But 10 people a HR manager cannot handle in his desk, because all the 10 will be sitting in front of him. Are you able to understand? Can you manage 100 people in your room? No. So that leadership quality is very essential for a HR manager, because that's how you can make the people follow you. Next one is technical expertise. This is a mandatory condition. If you have to become a HR manager, you should know the technicalities of HR, all the rules and regulations of the company, all the rules and regulations of that particular jurisdiction, of that particular country, right? So this is what we call as technical expertise, because you are, once again I am reinforcing, you are dealing with people. People tend to go to court. They will sue for anything which is done wrong to them. So unless you have a strong technical knowledge of what is in that country, the rule is regarding this HR, it will be in vain. You cannot be able to manage. Then it is related to the first point again, cross-cultural awareness. If you are transferred to a new place, or you are having people from various places, in both cases, right? Vice versa. I may go to Mumbai, I should know what is that. But if I am in Chennai and I have Mumbaians working in this company, I should know about Mumbai also. Are able to understand both sides. Cross-cultural awareness is must. Because see, in Fridays, usually if you have Islamic friends working in your company, Fridays, they would like to go for a namaz, they want to go for mass. You should be able to accommodate them, to enable them to follow their own practice. There is nothing wrong if you give them 10 minutes early break. They will come 10 minutes early. That's all. You cannot make it, it's a big rule or make a big fuss about that. This is what we call as cross-cultural awareness. You should understand what is important to them. Like, for example, a mother feeding, a young mother who wants to feed her baby should be given the freedom. You should be able to respect and understand that particular culture and give them a small space to do that. That's all. Okay. And the last one is relationship management. All these culminates to the last point. Whatever we have seen on the top, all this comes to the relationship management. How you manage relationship between you and your subordinates, you and the other people you have hired, you and your superiors, and the relationship between two equal hire, which people you have hired. All these culminate. So this one, relationship management. So a good HR manager should have a better knowledge in relationship management. Is it clear? So
Yes,
we
ma'am.
have completed one hour. So I think, can we go for a 5 minutes break?
Yes, ma'am.
Sure, ma'am.
Yes,
Yeah,
ma'am.
yes,
Okay.
ma'am. Sure,
So
ma'am.
5 we will meet again, right?
Okay, ma'am.
Yeah, and I would like to hear from you some queries till all these slides before we start the next class. Okay?
Okay, ma'am.
Take 5 minutes break.
Okay, ma'am.
Shall we start?
Yeah, yes, ma'am.
Yes, ma'am.
Yes, ma'am.
Yes.
Hope you
Yes,
are
ma'am.
ready. Okay. So we move on to the next slide. I think someone has raised the hand. Jagdish, I think. May I know why? Srinivasan. Okay. Right. Nothing is there. Okay. Do you have any queries?
No, ma'am.
Okay.
No, madam.
So I have given you 3 scenarios, right? How a HR
Yeah, yes, ma'am.
department can be. You can just go through and give me your opinion. The first one says, the HR department which says that no failure. It's called deferred success. You can succeed later, right? That is one kind. The second one, a HR department which is facing a person who is saying that I have come out with an unemployment degree. The third one, if anyone has any questions, raise your hand and place over your mouth. So 3 scenarios you have here. Yes? Anyone has come across any of these situations in your real life? What about the unemployment degree? In India, we say that HR's biggest challenge is not educational qualification. It is the employability of the qualification the people hold. We graduate people, but whether they are employable, that is the biggest question, biggest challenge is posed. Are you able to understand these 3 scenarios? These are the 3 department attitudes you can see in any common organization, right?
Yes.
Yes.
Yes. So what is the difference? How these characteristics of the department is set? That is my question. It's like a culture developed in the organization, you know, we call it as organization.
The first organization is optimistic.
Okay.
And
third one
The last
is,
one doesn't allow you. It not allow you to do anything.
yes,
You
that
just
is
be a
autocratic,
listener.
right?
That's it. You
Yeah,
don't
it's
have
like
active participation.
it's like a Hitler's regime, right? My question is not that. Listen to my question. You would have studied about organizational culture, right? In your first
Right.
paper. A culture is set in any organization. So these 3 scenarios gives you 3 different organizational cultures. My question is,
Democratic and autocratic culture.
yes, how this is set in any HR department or any organization, how this is set, how to treat the people, how the culture forms.
This is set from the management point of view. First, they decide how to treat the people. Probably they set the policies for the organization, and everybody practices, and
Very
it
good.
becomes a habit and culture. Yeah.
Very good. Exactly. The culture forms layer by layer, right? So these 3 scenarios can be commonly seen in any organization. How the scenarios differ from one organization to another organization? It's because of the people who are setting that culture in the organization, right? It's because people act that way. In the first one, you can see the entire organization act that way. They encourage people. So the organization has a people culture of positive thinking. The third one you can say has the culture of autocratic attitude, that people are not allowed to give their opinions. So what happens, that organization is not a democratic place to speak with. So this is how a HR department paves way for the culture to set in, right? When you are recruiting people, automatically and unknowingly, you are making people get into the gel into that culture. So if there is a change has to be started in any point to change the culture, that happens from the HR department, right? That is for thinking. So for some food for thought. Okay. Now we come to the another important section of human resource in any country, any given country, right? We are studying this subject, human resource management, for a certain set of human resource. What is that called? Organized sector. What is an organized sector? Most of you may be having ID card, right?
Yeah, yes, ma'am.
Yeah, you have an attendance register.
Yes, ma'am. Yes.
Yeah, yes, ma'am.
Yeah, you have an identity, a role, a job description to your name in an organization, right? So this
Yes,
is
ma'am.
called as organized sector. Okay.
Yeah,
Now
ma'am.
imagine, do you remember the mason who is constructing in a nearest construction site you have seen? If you are even an engineer in that particular site, do you think you remember?
Yes.
Does he have a ID card?
No,
No.
no.
No, ma'am.
Does he have a description or any resume he has to give, or will you give an exit letter
No,
when he
ma'am. No,
goes
ma'am.
out?
No, no.
So can you see the difference? They are like faceless, identification-less, right? So this is unorganized sector. We never know how many people are working, how many are sent away, how many retired, how many were recruited, what age they have, nothing. So this is unorganized sector. Okay, let us see
Yeah,
point
ma'am.
by point.
Okay, ma'am.
Organized sector are enterprises like companies, whereas unorganized sector are small units usually, right? Because when it blows into a bigger one, automatically people who are to monitor, like inspectors to do that, will find that out and becomes an organized sector. But once again, this is based on the political situation of the particular country. Like, see, for example, like Bangladesh, if you take, in Bangladesh, unorganized sector can be huge, like 200 people working in a factory, and it will not be noticed by any person.